Hands Live, I'm Shauna Smith alongside Brad Smith. We got breaking inflation data out this morning. CPI crossing the wires right now on a month-over-month basis. CPI coming in line with expectations, a rise of 0.2% on a year-over-year basis. The headline number for CPI coming in line with expectations as well, 2.5%. That is down from the prior reading of 2.9%. Now the core readings for CPI on a month-over-month basis rising 0.3%, which is a bit hotter than the street had been anticipating for this month. Also 0.1% higher than what we saw in the prior month's reading. When you take a look at the headline core CPI number, that was actually in line with expectations on a year-over-year basis at 3.2%. So again, when you take a look at this print overall, pretty much in line with expectations, although, Brad, we did see the hotter than expected core CPI month-over-month print of a rise of 0.3%.
Yeah, some areas digging into this report that consumers out there are going to be paying close attention to, and our viewers as well who are watching some of the market reaction here as futures are still in negative territory. I just want to dig into some of the components here. The index for shelter, and of course, month after month, I sound like a broken record. The index for shelter rose 0.5% during the month of August. That was the main factor, the BLS says, for the all items increase here. But looking and digging a little bit deeper here, as you look through some of the indexes that actually rose the most during the month as well, or increased during August, including shelter, you had airline fares, motor vehicle insurance, education, and apparel. So everybody out there trying to get a swag, they ultimately contributed to that. But then you think about the indexes that decreased as well. And this was interesting. Indexes for used cars and trucks, household furnishings. So not as many people buying lazy boys and couches perhaps, or at least pushing back on the pricing there. And then additionally, Medicare, communication, and recreation also among those that decreased over the month. So all that considered, we're still taking a look at futures down across the board as of right now, Shauna.
Yeah, we are looking at a bit of a drop here on this report. I think a lot of that has to do with that core CPI month-over-month print of a rise of 0.3%, a bit hotter than expected. And of course, that begs the question, how big of a problem maybe that could be for the Fed when you bring up the debate between 25 and 50 basis point cut and you take a look at that hotter than expected month-over-month print. It would make it a bit more tougher, I think, to argue for a 50 basis point cut here at the meeting next week. But let's go over to Josh Schaefer. He's got a closer look at this reaction that we're seeing play out in the market. Josh.
Hey, Shauna. Yeah, so futures taking a little bit of a leg lower here. You're looking at the futures tied to the S&P 500, down about 0.4%, was down as much as 0.5% as you guys were reading through the report. Take a look at NASDAQ futures, also off about 0.4%, and the Dow futures have been the laggard this morning, down about 0.6%. Now I'm going to flip over to the chart if I can here, and you'll see gold futures did tick up a little bit on this report. Initially moving up a little bit here. Remember, it's only 8:33 here, so we don't have a ton of look into what's going on, but I want to take a look at a couple other things. You can see Bitcoin here also rising slightly. Interesting thing with Bitcoin to point out, and this is something we'll probably be talking about later today, but Bitcoin took a pretty significant leg lower last night during that debate as the odds for Trump to win the presidency sank. You can see that right here. So that's sort of the action we've been watching in terms of Bitcoin. I don't think we're going to have updates yet on quite our 10-year T-note, but I'm going to take a look at the last 5 days, and you can see the direction has been generally lower for the 10-year. The direction has been generally lower for the 10-year really over the last 3 months now. And so that's something we'll be watching as we get that data coming in throughout the day. I'm going to take a look just at the S&P 500 here and the market action we've seen recently. So what we've been watching over the last 5 days, as we know, last week we had the worst week of 2023. We've started to recover. We're almost back to where we were before that jobs report. So we'll see how markets react, guys. One thing I'm taking away from this report was we know if CPI came in better than expected, it felt like economists felt that could make the case for 50 basis points. Maybe that would have helped markets a little bit more in early trading today, but it doesn't seem like that's the read through. One other reminder, we're going to get PPI tomorrow. Economists usually wait and combine PPI and CPI. That's how they get a great read on what PCE will be for the month, and the Fed will get a great read on what their favorite inflation gauge PCE will be for the month. So still a little bit more inflation data to come perhaps maybe markets waiting for that tomorrow as well.
All right, Josh, appreciate the breakdown there and the setup for today's market action as well. Joining us now to continue the conversation around the August CPI print, we've got Jennifer Lee, BMO Capital Markets Senior Economist, and Eric Wallerstein, who is the Yardeni Research Chief Market Strategist. Great to have you both here with us. I mean, I'm sitting here taking a look at the CME FedWatch probability here, and even though we're waiting for a little bit of an update here to perhaps factor in exactly what we saw come through CPI, it still looks like there's handedly this probability that leans more towards a 25 basis point cut. And Jennifer, in your notes to us, you say that's the big question, whether or not it's going to be 25 or 50. Does this report solidify that the Fed can feel comfortable with a 25 basis point cut?
First of all, good morning, and thank you for having me on. And I would say totally solidifies a 25 basis point cut. I don't think we were ever really in the 50 basis point camp. Even after last week's jobs reports, I don't think that it wasn't so broad-based weak that it would, I think, push for a 50 basis point cut. So I think this report, this would be the fifth decent report in a row for the Fed, giving them the comfort and the confidence to cut again or to start cutting. And I think 25 basis points is a good place to start.
Eric, what do you think? Do you agree?
Yeah, I think 50 basis points also was not in the cards, nor is that really a thing the Fed would do absent recessionary conditions or a financial crisis emerging. And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk. And even the biggest doves have signaled, it's a labor market that's cooling. We're going to go a quarter point and then go from there.
Eric, do you see a 50 basis point cut before the end of the year after the election?
No, I think you, again, need a crisis or a recession, which we definitely don't foresee. So I think if anything, and we'll see in the summary of economic projections, if anything, they go a quarter point at each meeting.
Jennifer, as I'm taking a look through some of the indexes here within the CPI, of course, shelter is the one that catches the attention naturally. I mean, at this juncture, is there anything additional that you expect the Fed to be able to enact, the levers that they are able to pull in order to start attacking some of the biggest components that are contributing to this continued rise in the all items index, which is notably shelter right now?
Right. So, there's only so much that monetary policy can do. It's a very blunt instrument, as we know. Some of the other factors, contributing to, it's basically like, low inventories still, off the lows, of course, but low inventories of housing available still. And there's, that has been an issue for some time, with land availability, labor availability as well. So that's, that's one of the sectors, by the way, that we're still seeing a shortage is on the construction side of things. And that's hampering, I think, the ability to build, and that's also pushing, the rent prices or housing prices higher. So that's something, again, that the Fed cannot do directly. But overall, just dampening demand will, at some point, that's what's taking effect right now. This is what's causing the economic slowdown, or what's contributing to the economic slowdown.
Eric, maybe to no surprise, we are seeing futures under a bit of pressure here following the hotter than expected core reading on that month-over-month basis. When we talk about the odds maybe increasing slightly here for the Fed then to go 25 basis points next week, what do you think the likely equity reaction is going to be?
Yeah, I think 25 basis points, it'll definitely depend on what the SEP and then, what Powell says at the press conference. I think if they went 50, equity markets would fall and bond markets would rise. I think it would signal the economy is heading in the wrong direction. We're behind the curve, and then it would, kind of unleash the volatility that we saw with some of the carry trade unwind as Japanese rates and US rates come closer together. So I think 25 basis points is probably priced in. It's always fun to say things are just always priced in, but I don't think that should, wrangle the equity markets too much.
And what kind of moves thereafter do you believe the markets are trying to price in as well and get some early inclination? Or is that something that we have to wait until the 17th and the 18th after the FOMC meeting, Eric, to really get a sense of where the markets can continue to price in what the pathway might look like?
Yeah, I think the path looks pretty extreme right now based on market pricing. A terminal rate that's around 2.8%. I don't think the Fed is going to get there, and especially how quickly the market thinks the Fed is going to cut rates below 3% just in the next 12 months. I think that's overzealous. I think the market's been doing that this entire cycle. They priced in 7 rate cuts at the beginning of this year, and now we're arguing about the first one with only a few meetings left to go. So I think those expectations will come off, but I don't think that's a huge worry for stocks. I think if those rate cuts get priced out because growth is stronger than expected and GDP comes in strong for the third quarter and the labor market indicators aren't too bad and we keep seeing consumer spending, then stocks will have more room to run as earnings continue to grow. So I don't think it's a huge deal if the Fed doesn't cut that much. I hope they don't, because that would probably mean we're in a recession. But yeah, the pricing is pretty extreme.
Jennifer, what's your assessment just on the economy's footing at this point, right? We have seen a weakening labor market. That has been a concern, especially to some on the street. But you pair that with the fact that inflation does seem to be under control. The Fed doesn't seem to be panicked at all at this point. Are you confident that we are going to see a soft landing?
So we are, that we're still very much in that camp. And I have to say, I completely agree with Eric. I mean, I think a 50 basis point cut would reek of panic. And it's almost like, we're totally behind the curve at this point. So it makes sense. We saw an upward revision to Q2 GDP of 3%. Of course, that's a look in the rearview mirror, but still, the latest numbers that we saw for personal spending for July was still pretty decent. And there's across the board spending increases overall still. So, it's still looking at a soft landing. Things are slowing. We're tapping on the brakes, and that's completely as expected after 525 basis points of rate hikes. This is completely the fact that the U.S. economy has held up all this time just speaks to the resilience of it all, I think. But I think soft landing is still very much in the cards. But of course, everything is going to be data dependent.
How might tapping of the brakes translate through to the employment situation and the broader labor market as you're tracking it, Jennifer?
I mean, we're still seeing job gains, which is a good thing. I mean, the first thing, right before the number came out, I remember saying, as long as we're going to see a plus sign, that's a good thing. But as long as we're seeing job gains overall, and over 100,000, almost 115,000 was decent in historical terms, but obviously not compared to what we've seen lately. And the jobless rate of just over 4% is still very low in historical terms. So again, we're still seeing that gentle rise, I guess you want to say, for the jobless rate slowing in job growth, but there is still labor demand out there, and especially in certain pockets. So I think that would translate into the overall narrative of a soft landing.
All right, Jennifer Lee, BMO Capital Markets Senior Economist, and Eric Wallerstein, Yardeni Research Chief Market Strategist. Thanks to you both for joining us here this morning.
Thank you.
So a quick recap of the August inflation print, coming in mostly in line with expectations, although slightly hotter than expected. A core print here on inflation on the month-over-month basis, a rise of 0.3%. The estimate was for 0.2%. I'm talking about the core basis here. That's spooking the markets just a bit. We are taking a look at futures under a bit of pressure across the board on the heels of that print. All three major averages on track to start the trading day in the red. We've got much more for you. Stick with us. We'll be right back.
August's inflation print coming in line with expectations, with the core reading coming in just slightly hotter than expected on a month-over-month basis. We're taking a deeper dive into some specific sectors here. We're joined now by our housing reporter, Danny Romero, and senior autos reporter, Pras Subramanian. So, Danny, let's start with you and one of the stickiest segments of inflation. What are we seeing on the shelter front here?
Brad, it is no surprise that the shelter component remains one of the stickiest parts of the inflation picture. Shelter posted a 0.5% monthly gain in August. Now, on a yearly basis, shelter came in at a 5.2%. This figure is softening if we compare to when shelter peaked at 8.2% in March of last year. Now, remember, economists pay close attention to two significant factors and that hold the biggest weight when it comes to the shelter index. That's owner's equivalent rent, OER. That's the hypothetical rent that you would earn if you were a homeowner renting out your property, and rents, which lags real-time data because the government collects this every 6 months, which causes a lag in the index. OER came at a 0.5% gain in last month, while rents came in at a 0.4% gain in August.
Yeah, we certainly have heard Powell talk quite a bit about shelter and the stickiness there that we've seen over the last couple of months. Pras, let's turn to autos because that's been another focus here. I know you're closely tracking that, and it seems like the situation's improving out there, at least if you're in the market to buy a car.
Yeah, just overall trend down, lower, not sticky like housing. It's been really kind of reacting to what's happening in the market. So for new cars, we see flat for the month, but down 1.2% year over year. But for used cars, down 1% in the month and down 10.4% year over year. So a big move there for used cars. That shot up tremendously during the pandemic, and now it's been coming down, but still higher than when it was prior to the pandemic. So good news there for car buyers. There's a lot of inventory out there. Dealers having to incentivize people to buy these cars. So that's normalization there and good for consumers, not that sticky with regards to cars.
And so normalization, I mean, what does that spell out in terms of some of the larger trends in terms of the pricing that consumers are going to be looking across, especially as we've moved now, it seems, from the trove of or wave of EV demand to now, okay, maybe I can get that EV used, or maybe I can still get an ICE engine and still get a favorable price there. How is that mix setting up right now?
Yeah, I think it's a pretty much a buyer's market now, back to those old days where you go into a dealership and you can actually negotiate a deal. Used cars in particular now, there's more supply coming online off lease cars, things like that. But also in the new market, like you mentioned, there's tremendous deals for EV, especially lease deals.
Right.
A lot of supply out there. The 2025 models are coming out this fall, so we're going to see a lot more potential action there for consumers to negotiate a better deal.
Yeah, it certainly seems like there is a lot to like in this print beyond what we're seeing, even when it comes to vehicles, when we see some improvements elsewhere. But Maddie, circling back to shelter, and since it is so sticky, you mentioned the fact that this is going to take time to improve. Walk us through, I guess, what that could look like then, given the lagged effects that we likely will see, and how long this could potentially be an issue here in these prints.
That's the number one question, is how long will it take? But policy advisors at the Bank of San Francisco, they released a note just last week saying that they're expecting shelter inflation to decline in the next few months, which will put downward pressure on overall inflation. However, it's still uncertain how the magnitude and the pace of when we would really actually see that in the shelter component specifically, Shauna.
All right, Danny, Pras, great stuff. Thanks so much for breaking that down for us. Let's hone in on the shelter component of August CPI data. The index rising 0.5%. The Bureau of Labor Statistics attributing it as the main factor in the items that we did see increase. Joining us now, we want to bring in Brian Rose. He's UBS Global Wealth Management Senior U.S. Economist. And Brian, let's just start there. When it comes to the stickiness of housing, how long it's going to be an issue, how big of a drag this will likely be in reports to come. What do you think?
Yeah, this is actually quite mysterious how things like OER are accelerating now. So the actual data on leases, we have this high frequency data showing when people are signing new leases, what their rents are. That peaked out, almost 2 years ago. And to see the OER accelerating at this point is very strange, very difficult to explain. There's a lot of nuances and unusual things in this data. It's very noisy. And there's also this question of when the pandemic hit and we had that big run up in rents, the CPI seemed to lag behind the reality. And then there's this catch up period. And it looked like that catch-up period was over, that we had caught up, but you see the data out this morning, it seems like, okay, maybe we haven't fully caught up to the sort of understatement that we had early in the pandemic. So yeah, this has proven to be unusually difficult to predict. And, overall, we know from the lease data that this has to slow at some point. It will slow because the rents aren't rising very quickly, but exactly when this will happen, is hard to say.
Yeah, and that's exactly what I was about to ask you, Brian. Like, how much of a lag are we expecting between it actually showing up in this data and then for the Fed to recognize that reality of the slowing and at least perhaps shelter not being the main factor that's contributing to the all items index?
Yeah, so already the lag between the reality and the CPI data is much longer than we've seen in the past. So you normally expect it to lag by around 12 months, but it's lagging in this case by more than 18 months. And there's this question of the catch up to the rent increases early in the pandemic and whether that process has finished. But one important point in terms of the Fed is there's a real question as to how much the Fed should worry about this because, OER isn't actually paid, right? This is sort of a theoretical cost, but it's not the actual cost. So it doesn't make sense to leave rates high because of this sort of theoretical cost of, how much would it be if you were paying yourself rent for the house that you own. And I think to some extent you have to look through this. And the Fed has talked about this. We know the data is lagging. We know the data on new rental leases isn't so bad. And if you look outside of shelter, right? The inflation rate, headline inflation, 3.2, but without shelter, it's only 1.1% year over year. So there's a real question as to how much growth are we willing to sacrifice? How much pain are we willing to accept in the labor market because of this very technical increase in things like OER?
Hey, Brian, while we have you, I want to take you to a quote that Dr. Selma Hepp, the chief economist over at CoreLogic, in their own annual U.S. home price growth study had pointed out for their summer release here and saying that summer brought notable cooling to the housing market. She also mentioned that housing demand continued to buckle under the pressure of high mortgage rates, unaffordable home prices, leading to a considerable slowing of home price gains during the summer. To what extent do you believe we need to see the Fed cut interest rates in order for mortgage rates to come down, but not so much so that it would impact on the other side housing prices to see even more bidding into them, which would keep the pricing sustained at this level, it would seem, at least in theory?
Yeah, so it is true that the combination of very high housing prices and high mortgage rates is making housing extremely unaffordable. So we haven't seen anything like this since the early 1980s when the Fed funds rate was up near 20%. Very, very unaffordable. And in the end, ultimately, we need more supply. So, you can talk about cutting rates or whatever, but we have a fundamental housing shortage. We just haven't built very much housing since the housing bubble burst and we had the global financial crisis. We haven't built enough, and we need to increase the supply. You hear at least Vice President Harris talking a lot about this issue. She has plans to try to increase housing supply, and that is really the solution. You can cut interest rates to help mortgage payments, but rents and housing in general will remain unaffordable until we increase the supply. There's just too many people and not enough housing to shelter them all.
So, Brian, I guess as we close this out, and it brings me back to your point before just about the debate of how closely the Fed should really watch OER and ultimately what that means, just given the fact that it is an estimation and the fact that shelter was the big driver in this month's rise that we did see, at least the higher than expected corporate. But when it comes to what the Fed should do at the next meeting, there is a school of thought that if they don't go 50 basis points, it could risk hurting the economy more. in the long run. Do you share that view at all, and why or why not?
So this is a very difficult situation for the Fed. Very, very difficult to understand exactly what's going on in the economy because all the data that we rely on has become less reliable since the pandemic. So more noise, more revisions to the data, more discrepancies between two estimates that should be the same in theory, but are very different when you see them. So the Fed's got a difficult situation to deal with. But I would say that the main focus at this point is on the labor market. So the inflation data itself doesn't add urgency to rate cuts. But what add urgency is, deterioration in the labor market, especially layoffs. So right now, what you see is hiring has slowed. New entrants are struggling to find a job, but the layoffs remain low. You can see initial jobless claims is still low. But if you start seeing those layoffs taking off, the Fed will get very concerned that it's behind the curve. That would add urgency. That would, make the Fed cut rates more aggressively. Without weaker labor data, I think the Fed would prefer to cut 25 basis points at a time.
Great to have you here with us this morning. Brian Rose of UBS Global Wealth Management. Appreciate the time and insights. Thanks so much.
Thanks very much.
Certainly. A quick recap of the latest inflation print on a monthly basis. Core inflation coming in hotter than expected. 0.3% rise versus 0.2% that was expected there on the August core CPI. Futures right now, they're under a bit of pressure around 30 minutes ahead of the opening bell. We've got much more for you here on Yahoo Finance when Morning Brief begins at 9.
It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Let's get to the three things that you need to know today, starting with the markets. Stock futures, they're under a wee bit of pressure here. Headline inflation matching expectations both on a monthly and annual basis, but stripping out volatile food and energy prices on a monthly basis, inflation rising 0.3% versus the 0.2% that economists were expecting month over month. Now, the annual figure, it did come in line with estimates. Traders, as of right now, they're pricing in an 85% chance of a 25 basis point cut in September. This is according to the CME Fed Watch tool.
Huge shift that we're seeing here in reaction to that. All right, well, the first and potentially only presidential debate between Vice President Kamala Harris and former President Donald Trump taking place last night. For 90 minutes, the candidates went head-to-head on the economy, inflation, and tariffs.
I imagine and have actually a plan to build what I call an opportunity economy.
We've had a terrible economy. We have inflation like very few people have ever seen before.
And what we have done is clean up Donald Trump's mess.
Everybody knows what I'm going to do. Cut taxes very substantially and create a great economy like I did before.
Well, let's be clear that the Trump administration resulted in a trade deficit.
Following last night's performance, the Harris campaign is now calling for a second debate.
And the debate sparking some market moves as well. Shares of DJT, Trump Media and Technology Group, falling as much as 18% pre-market. They're now off right now as well. They've been continuing to be under pressure. Bitcoin also has been tied into the Trump trade. Bitcoin seeing some pressure, falling as much as 2.5%, but off of those overnight lows. Crypto is also seen as a Trump proxy because he's embraced the industry and spoken at a few conferences on the other side of the aisle. Solar stocks seen as a potentially doing better under Harris presidency. You're seeing those rise here on the day. These are some of the largest by market cap, and they're all seeing some gains here in extended hours right now.
Let's take a look at how the markets are digesting this morning's latest inflation data. August CPI print was largely in line with expectations, though month-over-month core CPI coming in a bit hotter than what the street had been expecting, rising 0.3%. As a result, we're seeing some pressure on the major averages here in the futures market. At least you're looking at the Dow on track to start the trading day in the red, that along with the S&P 500. On the flip side, you got the NASDAQ 100 futures trading just around the flat line, searching for direction for much of the morning. And taking a look at the action playing out in the bond market, that's certainly to note here. We saw the recent rally in treasuries, that coming to a halt just a bit here in early action. You got the 10-year yields actually moving to the upside, hovering just around that 3.7 level. So prices declining there. Certainly something to note here in early trading, Brad.
Yeah, let's also check in on gold, if we may. Some of the commodities that we've been keeping close tabs on here as we're taking a look at gold futures, down just slightly by about 0.1%, but holding steady above 2,500, key psychological level there. And this all as we've been tracking what the CPI print is doing in terms of the broader market reaction that we just laid out for you. Inflation, we did mention this came in mostly in line with expectations. We did see a slight tick up on a monthly basis at the core level. Traders now pricing in an 85% chance, though, of a 25 basis point cut. Here with more is Scott Wren, Senior Global Market Strategist over at Wells Fargo Investment Institute. So, Scott, the probabilities, according to the CME Fed Watch tool, have shifted and now handedly looking at a 25 basis point cut. So what is this set up for September and the pathway beyond that?
Well, Brad, good morning. And, we had been in the certainly looking for 100 basis points in cuts in these three meetings. A month ago, we would have said they would have done 50 here in September. But I think the Fed funds futures are right. The chances are is that it's going to be a 25 basis point cut. Things like today's CPI data suggest that, the Fed can go at an even pace. And, the market's a little bit nervous. When I looked yesterday at Fed funds futures, there were 10 cuts or more than 10 cuts priced in between now and the end of 2025. I think that's too aggressive. I think the economy would really have to tank to see something like that. We're expecting a soft landing. We're not looking for a recession. So, the market's going to be very sensitive to this, but I think chances are that the Fed, they lower 25 basis points in September.
Scott, there's been so much made about 25 versus 50 basis points. Does it matter?
Sean, I don't think it does. We have, we're catering to retail investors here. And they are getting hung up on 25 or 50 basis points. And I don't think that's really the important thing to focus on. I think the important thing is that the Federal Reserve is just next week is going to begin a series of rate cuts. That's what we want our clients focusing on. And of course, the financial media, there's news out there, there's time to be filled, and the debate between 50 and 25 has garnered a lot of airtime. But in the whole scheme of things, we're going to have a lot of cuts here. And I don't think that investors should get too hung up on whether the first one's 50 or 25.
I feel slightly like a personal attack, but you know what? You made a lot of sense with it, Scott, so we'll let it slide here for today. All these things considered, though, I mean, if we were to see anything about and around 10 cuts, what does that put in your mind as a terminal rate that we should be looking out for once they begin the cutting cycle?
Well, we debate this in the investment strategy committee all the time because everybody has their own idea on what they think the neutral rate should be. In my mind, it should be 375 to 4, but some people think it's 3% or maybe even a touch lower. So I think the Fed probably, if you try to pin them down on what the neutral rate or the terminal rate might be, it would be somewhere between 3 and 4%. So, that's in the ballpark. Our theory is that they do want to get to neutral and that they're going to get there, relatively slowly. So as I said, we have 100 basis points penciled in for these last 3 meetings. I think you can certainly safely say that we're going to see 75. And once again, don't get too hung up on a quarter point here or there. We're going to see a series of cuts, and that's going to positively affect what is likely to be a slower economy here as we move into 2025.
Well, Scott, as we know, everyone loves to weigh in on what the Fed should and shouldn't be doing. And there certainly has been no shortage of critics out there saying that the Fed is behind the 8 ball, that they've already done more damage than you can tell right now to the economy. When you take a look at the CPI print, at least the core print that we did get, does that really put that argument to rest?
Well, I think the Fed didn't do a very good job when they left rates too low for too long. I think they've done a good job, though, as they raised rates. They raised it pretty quickly. Inflation is sticking around, and you guys in your last segment talked about shelter and housing. Well, I mean, that's a sticky component, and that's going to be sticky next year as well. So I think, it's tough to come up with new supplies of housing anytime quickly, but I don't think the Fed is behind the 8 ball. I think that, we saw with headline CPI and we've seen with the personal consumption expenditures, PCE, inflation is moderating. It's moderating slowly. It's likely to do that at least into the first half of next year. But certainly this housing shortage, it's not going to go away anytime soon, and houses are going to be expensive and rent's going to be expensive.
Scott, just want to get finally here actionable with some of the investors out there looking through this data point, trying to game out what the Fed's pathway might look like and anticipate their actions. What is the top trade or portfolio positioning that they should be thinking about after a data point like this and going into that next meeting?
Well, I think this bond rally that we've seen in the long-term 10-year Treasury, these rates are low. We don't think they're going to go much lower. So what we've been recommending that our clients do really over the course of the last 6 weeks or so is to take money from bonds and move it into stocks. So some people, we use short-term fixed income as a parking spot. We had been overweight long-term bonds, but we've seen a good rally. So we would take money from bonds, both short-term and long-term, and we would move that into the S&P 500. If you're underweight small cap Russell 2000 stocks, we'd bring that up to a neutral weight, which is what we did. We still prefer large over small. And then if you're looking at sectors, industrials, materials, energy looks attractive here. We don't think oil is going to trade much lower than where it is now. Communication services, which of course, has a couple members of the Mag 7 in it, that looks pretty attractive here. So I think there's some movement that you can do in your portfolios, but we've taken a step toward moving out of bonds after this big rally. We've tried to take advantage of lower stock prices and to buy some equities here, because certainly, we think the S&P is going to be near 6,000 at the end of next year. We want to take advantage of any pullbacks. We don't think interest rates are going to go lower.
All right, Scott Wren, always great to get your insight here, especially on a day like today. Thanks so much for taking the time to join us here. Senior Global Market Strategist at Wells Fargo Investment Institute. Thanks so much, Scott.
Have a great day, guys.
You too. Another top story that we are watching, the presidential debate. Vice President Kamala Harris and former President Donald Trump squaring off in Philadelphia Tuesday night, their first and possibly only debate ahead of Election Day. For 90 minutes, the candidates went head-to-head on a number of issues, including the economy.
We have inflation like very few people have ever seen before, probably the worst in our nation's history. This has been a disaster for people, for the middle class, but for every class.
His plan is to do what he has done before, which is to provide a tax cut for billionaires and big corporations, which will result in $5 trillion to America's deficit.
Joining us now, we want to bring in E.J. Dionne. He's Brookings Institution's Senior Fellow in Governance Studies and Government Professor at Georgetown University. E.J., it's good to see you. So let's unpack what we heard. There's lots to get into from last night, but let's start with that soundbite that we just heard on the economy, on inflation. Obviously, just a fact check here, former President Donald Trump's claims that this is the highest inflation we've ever seen certainly is not true, although we did see a big spike during Biden's administration, up to peaking around 9%. But I'm curious just first to get your reaction to last night and what your big takeaway was.
Well, I think she overwhelmed him is the bottom line. And I think that's the overwhelming consensus this morning. I saw a focus group this morning where by 23-2, the people in the focus group, these were undecided voters, said that Harris won. And I think there were several things that happened. First, she put him on defense right from the beginning. When she went and he was just going to walk to the lectern, she had extended her hand. He didn't want to shake her hand, but he had to, and said, "I'm Kamala Harris," pronouncing her name right. And that ended up setting the tone for the whole night. She was on offense all night. And we had never really seen this in quite the same way in a Trump debate. Trump was in the past masterful, particularly in the Republican debates back in 2016, with his little nicknames like Little Marco and the like, in putting the other person on the defensive. Last night, she put him on the defensive, got under his skin, and there were just many moments where, most moments actually in the debate, he veered off the message. The clip you showed was really a rare point where, despite the fact that he overstated it, to be gentle to him, overstated what was happening with inflation. That was one of the rare moments where he actually was on message last night. He spread those false stories about immigrants eating dogs and cats. He exploded at various points, and looked snarly all night, and she looked extraordinarily calm. It's just hard to see that debate as anything else but an overwhelming victory for her. And again, I don't think that's an odd view, a dissenting view. I think it's the overwhelming view this morning among Republicans and Democrats who watched that debate.
EJ, sorry, we have a couple more sound bites too here. Another topic talked about last night was the semiconductor industry. Harris calling out Trump for chip policies during his administration. I want to play this clip and get your reaction on the other side.
He invited trade wars. You want to talk about his deal with China? What he ended up doing is, under Donald Trump's presidency, he ended up selling American chips to China to help them improve and modernize their military.
We hardly make chips anymore because of philosophies like they have and policies like they have. I don't say her because she has no policy. Everything that she believed 3 years ago and 4 years ago is out the window.
Now, it's going to be an amazingly important topic, of course, EJ, especially given where the industry is moving. You have NVIDIA talking about 1 million chip data centers. We heard from Oracle and saying that they were going to be using nuclear reactors to power data centers, all these things considered. Where did the candidates line up on this issue from your perspective?
Well, it's funny, you have picked out, to your credit, relatively substantive moments in a long debate. I think that what the difference is, I think, to the extent you could discern it from that debate, which I'm not sure you can. The Biden administration and with Harris's support has invested a lot of money in domestic technology, including the chips industry. I think if Harris wins the election, I think you will have a continuation of broadly speaking, where the Biden policy is on this. On Trump, it's hard to say from his answer, because again, I think that clip was revealing in the sense that what Trump was moved again on the defense, and then he tried to flip it to a general attack on Harris. And I think that was his problem all night, is that he'd get in a corner and then he'd reach back to some boilerplate attack to try to get out of it. And it just didn't work very well.
EJ, I also want to ask about something that wasn't actually discussed last night, and that was deficits, budgets. I think it was only mentioned once. And I bring that up because of the real issue and ultimately maybe the risk or challenge that this clearly does pose, many would argue it poses, to the economy down the line. Why, from your view, since you've been covering this obviously for decades, for such a long time, why isn't it more of an issue, more of a focus in presidential elections, and should it garner more attention?
Well, I think that, for one thing, we got used to higher deficits during the pandemic, and that we needed to pull ourselves out of the economic collapse that happened with the pandemic. Spent a lot of money. Both parties voted for that. And the other thing I think you've seen is that for a long time, Republicans have made the argument that, well, if it's for tax cuts, if we are increasing the deficit for tax cuts, that's okay. And the difference between the parties is now which party will increase the deficit less. The economists who do the numbers say that, the Harris side is willing to increase taxes to contain the increase in the deficit. But I don't think at this point people feel the threat of the long-term deficit, because, the big news, you talk about a campaign getting good news. The Harris campaign got Taylor Swift's endorsement last night, and then gets this very good news on the inflation rate this morning. So at this point, I don't think people have felt the bite yet of the deficit, and neither party sees any interest in making that the centerpiece of their campaign.
Sounds right. EJ Dionne, always great to talk to you. Thanks so much for joining us here. Brooks Institution Senior Fellow in Governance Studies and Government Professor at Georgetown University. Thanks again.
Great to be with you. Thank you.
Brad?
Well, the presidential debate is moving some stocks this morning. Let's take a look at shares of DJT. They are down pre-market by 15, nearly 16%. And at this level, it will set a new 52-week low once trading commences, which also means this will be the lowest point that shares have hit since Digital World merger with Trump Media and Technology Group was approved, giving way to the DJT ticker here. So we'll continue to track that. Also, we're tracking cryptocurrency, Bitcoin, paring back some of the earlier losses as well. Let's take a look at Bitcoin, and ultimately, as of right now, it's up by about 0.2%. So maybe decoupling a bit from the Trump trade as of right now. We'll see. And then lastly here, let's take a look at MicroStrategy as part of the broader crypto trade as well, MSTR. Of course, you will remember Michael Saylor, who has tweeted about former President Trump speaking at the crypto conference here. But could that decoupling continue? We'll see. MicroStrategy down 2%. Shauna?
We're taking a look at a live view of the floor of the New York Stock Exchange, preparing to hold a moment of silence in remembrance of the victims of September 11th, 2001. Today marks 23 years. Let's take a moment of silence in remembrance.
Now time for some of today's trending tickers here. And throughout the day, you can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Scan this QR code you see right there below to check out the latest here. First up here on the day, let's check out GameStop. GME sinking right now by about 11% today after reporting sales that missed estimates and fell more than 30% in the prior quarter. The company also disclosed an at-the-market stock offering of up to 20 million shares. So focusing in on the latter first, typically this is the type of reaction that you would see in the stock when there's an at-the-market equity offering, because that just means there's a further dilution of shares that are already in the market here. But then looking into some of the fourth quarter, actually not the fourth quarter, but the quarter results here. One of the huge things going forward from this juncture is just trying to figure out exactly how they're going to continue to move through a lot of the inventory that they have. Net sales, they were down and not even close to what the prior year's second quarter was. $1.164 billion last year, same quarter. This year, $798 million.
Yeah, certainly. I think when you see a drop like this, not necessarily a huge surprise. We talked about the fact that many times this stock trading unrelated to fundamentals, although it looks like when you take a look at the stock's reaction here today, you can see how far and even further out many analysts, or some of the analysts, few analysts that still cover GameStop would argue that GameStop is still trading well above where it should be on a fundamental basis. But again, shares sliding on the disappointing report. Baird saying that the results demonstrate the ongoing quote unquote challenges to the company's retail business model. Also went on to say that they also have limited confidence in GameStop's ability to restore growth and improve profitability. Not exactly too new of different of an opinion that we've heard from some of these analysts over the last couple of quarters. Let's keep an eye on some of the bank stocks here. JP Morgan leading the route as the biggest bank in the U.S. tempers its revenue optimism and saying that forecasts for net interest income aren't realistic. That was our president making those comments during a conference yesterday. We're looking at a further decline of just about 0.2%. But yesterday's drop, shares falling the most that we saw in just about 4 years following those comments from their president, Dan Pinto. He also went on to say right now the current net interest income estimate of $89.5 billion is quote unquote not very reasonable. The figure quote unquote will be lower, he said. And remember that Pinto wasn't the only one that was raising some red flags, ringing some alarm bells yesterday and over the last couple of days. On Monday, we heard from Goldman Sachs CEO David Solomon. He made the admission, or was basically warning, that trading revenue at his firm was on track to drop 10% in the third quarter. We also heard from Ally Financial yesterday saying that auto delinquencies and net charge-offs were up more than expected. So again, some of that optimism that maybe we have seen priced into some of these stocks, some of these executives warning that, hey, maybe it isn't as rosy as what has been priced in up until this point. Yeah, it seems like for Goldman, it was the unwinding of their consumer business as was part of that $400 million hit that they were disclosing. And then additionally here, thinking back to JP Morgan, and I think you laid it out quite well on what they're expecting. One thing that we're also expecting is to hear a little bit more about who the next leader of this company is going to be. And you mentioned Daniel Pinto. Don't be surprised if you continue to hear that name over the coming quarters here, as Jamie Dimon was speaking as well on that, just talking about Daniel Pinto and the succession plans here. Here's what Jamie Dimon said yesterday. We all want to get that exactly right, as talking about the extremely qualified people. He said this at an event in New York. And most notably here, he said that Chase president Daniel Pinto could run the bank tomorrow. And so with that in mind, you've got a host of names that are very close to Jamie Dimon within the organization that would all be within the realm of possibility of taking over the top job. And we'll see exactly who ultimately gets the nod, but that's a high vote of confidence coming from Dimon right now in Pinto. Yeah, it certainly is, and there's a number of names that JP Morgan is rumored to be considering. And also remember that the timeline of this is really what is in question, because Dimon has signaled that it's no longer something that he's talking about in 5 years, but it could be something in 2.5 years. So again, the focus on that succession plan, given the fact that he's been at the helm of the bank since 2006, certainly a massive focus here for investors and obviously those inside the bank as well. Absolutely. All right, let's stay with the banks. Why not? XLF, it's big bank energy here this morning. Sticking with banks, Morgan Stanley cut to neutral by Goldman Sachs, saying the bank has less recovery than peers in the investment banking divisions, and citing some downside risk
risk to estimates for 2025 wealth net interest income here. The shares of Morgan Stanley, ticker symbol MS, they are down by about 1.7% here. And just thinking through how the banks are navigating what's been a massive week for announcements from Basel III all the way through how they are working with their wealthiest clients. For some of those extremely high net worth individuals, portfolio rotation right now has seemed to not just go towards what some of the most popular instruments have been and making sure that they're over-indexed in things like and have exposure to some of the sexiest elements of the market, but also having cash that is sitting on the sidelines too, so that they can deploy and look at some of the dip buying opportunities. And so that potentially could be a hit in the near term to that ultra high net worth individual or some of the wealth management divisions. If you have more people that are saying, okay, keep some dry powder in the coffer right now because we're going to be wanting to hop on some of those opportunities. So that's revenue that this company is not going to see, at least in this near term period of time.
Yeah, and that was part of the analysis here, taking a look at their wealth management division specifically, suggesting that 3% downside risk to the bank's 2025 estimated net interest income, also a 40 basis point margin downside compared to the street's expectations. And then beyond that, some of the concerns here was for valuation here when you take into account where Morgan Stanley is trading relative to peers. Year to date, we haven't seen much action over the past year. It's up nearly 14%. But again, Morgan Stanley cut to neutral by Goldman Sachs, and they're seeing reason to stay on the sidelines for now.
All right, here you're seeing a live shot of the New York Stock Exchange. That is the opening bell, and you've got 9/11 or ringing the opening bell at the NYSE and at the NASDAQ. You've also got a shot of the opening bell ringers, Tuesday's children ringing the opening bell there. That was the opening bell here in the U.S. and taking a look at where trading commences here on the day. We've got a look at the Dow Jones Industrial Average. This is, of course, a big economic data point day with CPI. We brought you special coverage here, and it came in linely year over year with estimates, slight rise that we had seen versus the expectations on the month-of-month core. But all things considered, you're seeing some fractional market activity. The Dow Jones Industrial Average right now down by about 0.5%. Let's give you a chart to look at, a fancy chart here on the day. Actually, let me go back here and just populate this chart, and we'll give you a week-long view just to see how things have been shaping up over the course of this week. So still net positive over the past 3 days here, but ultimately, as of right now, we're seeing a move to the downside out of the gate for the Dow Jones Industrial Average. NASDAQ Composite, that's up fractionally by about 0.1%. We'll see if we can hold on to those gains. And then the S&P 500 out of the gate right now, it is down by about 0.2%. And then just lastly, let's load you up with some heat maps as you begin your trading session here. I heard you like colors, so we've got plenty of them here, as long as we can toggle over there. Seems we can't, so we'll keep a close eye on those 11 S&P 500 sectors as we move on throughout the rest of today's trading activity. Shauna?
We will be keeping a very close eye on those sectors and the action that we are seeing. All right, keep it right here on Yahoo Finance's Morning Brief. We got much more on the other side. We'll be right back. Time now for today's strategy session. U.S. stocks fluctuating at the open as traders digest today's CPI print, showing a surprise acceleration in consumer prices, at least on a core basis. Joining us now, we want to bring in JJ Kinahan. He's IG North America's CEO. And JJ, when you take a look at the stock's reaction, we're not too far from the flat line, but I'm curious what your first take is of this inflation print and maybe what it tells us about what we'll likely hear from Powell and team next week.
Well, I don't think it really changes their, assessment of things. It seems that the market has already basically built in, Sean, to the fact that they are going to take 25 basis points. I think those who have been talking for 50 basis points or a certainty around, 3 or 4 rate cuts before I guess it would have to be 3 for the end of the year, that I think is still a little bit perhaps overstretched. And so, this was a bit of a, I don't want to say nothing burger, but it kind of was, in the fact that I don't think it gives us any clarity one way or the other. The one thing that does stand out to me on there, however, is that the core prices for food and energy really didn't move. And I think that that's one area where the average person would really like to see things move. Now, we may see the energy prices next month come down, as we have seen crude oil, as you know, and report on every day, crude oil sell off quite a bit over the last week or so. And so that may just be a delay in how, timing of the survey or whatever it may be. So there, I think, is where we need to see things start to come down before it truly helps the economy.
JJ, as we think about not just the data that really keys up or tees up rather this cutting cycle, more broadly the outperformers that tend, at least historically, to do well in cutting cycles, technology. But technologies run so fast and so far so quickly. When you think about what the setup is for technology in this next cutting cycle, do you expect that historical element to reign true again, or are you expecting some type of repositioning here?
Well, I think, Brad, so many times people over the last couple of years have said, the tech stocks cannot continue to carry us, et cetera. And they've proven everybody wrong every time. Now, we have seen NVIDIA, come into some troubles recently, but I think you have to keep that in perspective that the stock is still up over 100% year to date. And so I think any CEO in the world would be like, oh, please let me run into trouble up 100% on the year. And so, overall, I think it's really sort of short-sighted to say that technology will not continue to lead us. The one area of technology that's starting to be questioned, and I think will be something that they do have to prove, however, going forward, is all the spending in AI and how they can really monetize it. If you think about NVIDIA, what they're actually doing, if you compare them to a gold rush, they're the ones selling the shovels. Very wise, because it doesn't matter if the other people make money or not, but long term they have to in order to keep buying your shovels. And so with that, what we've seen in the last round of earnings calls, really for the first time, was analysts asking the CEOs, okay, how are you going to monetize it? I do think you're going to start to see a lot more pressure there because we've seen hundreds of millions of dollars spent on AI. That, to me, will be the key of whether we can continue the rally or not in a bigger way. One of the things I think many of us were hoping is that the financial sector would pick up this and continue to lead us, so you could have tech and you could have financials going together. Obviously, in the news that we've seen over the last couple of days, and you guys just reported on, the financial sector really having a bit of a tough sled right now. And so I think it's going to be very difficult in a rate reducing environment for them to really get back on track in terms of their earnings also.
JJ, we talked to Scott Croner over at Citi yesterday, and he was making the case that NVIDIA is just becoming a quote unquote, I think he said, just another large cap growth name. Do you share in that sentiment, just in terms of the fact that we are seeing the sentiment on the street shift away from technology, and maybe so much emphasis isn't going to be placed on NVIDIA and those AI names that you were just talking about?
I think we're not there yet, Jonah, because when I look at the retail client right now and I look at our clients trading through Tasty Trade, NVIDIA is still the name that, different stocks go through this at different times. For how many years was it Apple? I think NVIDIA has taken the place in terms of a confidence monitor, if you will. So as people get more confidence in the market, more people start to buy NVIDIA. This is a stock that's almost always a bullish play for our clients overall, and I think for the street overall. So, maybe you could make the case that it's starting to become just another stock, but there is a confidence that goes with NVIDIA when it's doing well that gives the average retail client some confidence also. That, like I said, Apple, we needed somebody to fill that void. And NVIDIA has certainly done that over the last year and a half. We'll see what the next stock is that does it. But for right now, I really feel NVIDIA will continue to do that for at least the next 6 months or so.
And so if that's where your clients are signaling they're the most bullish, where are they signaling they're the most bearish right now?
Well, there's a few other stocks they're bullish on right now. Also, Ulta and UPS are two that I think are really interesting. But on the bearish side, Lululemon is one that we've started to really see a lot of bearish activity over the last couple of weeks, and one related directly to technology, Qualcomm, and particularly through the, many people seeing that it could go back down and test that 150 area. We've seen a lot of 150 puts over the next month and a half bought in Qualcomm. So that's one I definitely have my eye on. And then the third one, maybe a surprise to many people, Disney. I don't think what's going on with DirecTV right now is helping them because so many clients are shut out from the Disney channels, et cetera. I'm sure you guys saw, a lot of people online, particularly with Monday Night Football the other night. People were not happy about the fact that they could not watch it. So we'll have to see what happens on that one because I think that's turned a lot of consumers sour recently on that. So those are three stocks right now that I find very interesting that our clients playing to the downside. But Qualcomm probably the one that's most interesting to me to watch because, again, it relates directly to where we started this conversation.
All right, JJ Kinahan, who is the IG North America CEO. Thanks so much for taking the time here with us, JJ.
Have a great day, guys.
You too. Coming up, everyone, Hurricane Francine is set to make landfall in Louisiana today. The weather event already taking a toll on Gulf production and oil prices worldwide. We'll take a closer look next on Morning Brief.
Oil rebounding this morning from its lowest level since December of 2021. Traders weighing concerns about looming oversupply and tracking impact from Hurricane Francine, which is expected to make landfall in Louisiana today. So maybe offsetting some of the losses that we saw earlier this week. We want to bring in Tom Kloza. He's Opus Global Head of Energy Analysis. Tom, it's good to see you. So we certainly have concerns about oversupply that had been weighing on the oil markets. Now we're turning our focus to the threat of the hurricane and maybe exactly what that means for the energy market here in the U.S. Do you see this movement, the slight movement higher that we're seeing this morning? Have we seen a floor in crude?
Well, we're going to see a floor at some point here, but I'm not so sure it's now. And by the way, that Hurricane Francine is really not a major event. It speaks to the issue that every hurricane that makes a landfall on North America destroys demand. It's really the rare one out of 50 or so, that destroys supply. And this one, based on where it's entering, is not going to really destroy any supply. It does bring kind of a microscope to the fact that we've got a lot of deep water and Gulf of Mexico crude, including probably close to 500,000 barrels a day of additional crude coming on from those sectors in the next few years. So oil is a problem. This has been a very, very bad week for all the oil analysts, for companies or countries that are in OPEC, and for all of the entities that try to measure the temperature of crude.
And so with that, you mentioned in your notes to us, there's lots of diversity in the prices, but recent months have demonstrated some deflation in gasoline, not enough to make up for severe inflation in the cost of lodging. So, all these things considered, how is what we're seeing in the oil prices and the broader oil price action that has seen some new 2024 lows and even cracked through December 2023 lows, how's that playing throughout the rest of the areas of the economy where oil is one of the key cost inputs?
Well, here's where everyone was caught sleeping. The actual physical demand for oil in August was probably the highest month ever. The greatest, I wouldn't call it a shortage, but relatively tight supplies of physical oil. What happened this summer, and what continues to happen, is that you do not have speculators buying futures and options contracts anymore. Instead of being 10, 15 to 1 of people who are buying crude on the auspices that prices are going to move higher, you're seeing no bias whatsoever. And that's going to be something that people have to get used to. The fact that we didn't see more speculative money or more investment money come into the market when we had everything going on in geopolitics from last October 7th, that might represent a real sea change for oil, because a lot of the price of oil through the years has been the physical market, but a huge portion of it has also been the sentiment and the positioning. And right now, financial participation in oil markets is probably as low as it's been since oil really became an asset class.
So, Tom, then what could turn the tables? If we're looking for events, something like that could shift the sentiment that we are seeing, or demand here, that we are seeing for crude, or maybe more specifically supply, what should investors be keeping a close eye on?
Well, I think there's a few things, and some of them have been happening. We need to watch the drones through the next few months that are being flown from Ukraine into Russia to attack Russian infrastructure and refineries. The world still needs Russian crude oil, and it needs Russian refined products. Maybe Europe doesn't get them anymore, but Europe has to get product from other places that used to be supplied. The other thing that can happen is, obviously, there could be tougher suppression on crude oil exports from Venezuela and Iran. That might happen, for example, on a short-term basis if we get a Trump 2.0 presidency. And then, the final thing is OPEC. I mean, OPEC has really whiffed on this one. They need to cut more oil as opposed to restore some of the production cuts that they made in 22 and 23. And right now, they're ready to pump a few 100,000 barrels more on December 1st.
It's interesting that you mention who and the presidency itself, as we're staring down a general election in less than 90 days here. ultimately many of the American public watching the debate last night here. And we were paying close attention to what the candidates had to say about energy last night. Harris and Trump certainly had conflicting views on the sector. Wanted to play a quick clip and then just get your reaction on the other side, Tom.
Sure.
My position is that we have got to invest in diverse sources of energy so we reduce our reliance on foreign oil. We have had the largest increase in domestic oil production in history because of an approach that recognizes that we cannot over-rely on foreign oil.
But if she won the election, the day after that election, they'll go back to destroying our country, and oil will be dead, fossil fuel will be dead, we'll go back to windmills, and we'll go back to solar, where they need a whole desert to get some energy to come out.
So, Tom, just help us make some sense of this and what the candidates, even as they were sparring yesterday evening, last night, which of these candidates would actually be better for the energy sector if there is a clear indicator or an either-or in this situation?
Well, it's a mixed bag. I mean, whoever gets elected in November is going to be very, very fortunate in that they're going to be dealing with some of the most serious energy deflation since 2014 or since 2020. Kamala Harris is accurate in that we've seen an explosion of crude oil production, natural gas production in the Biden years. The problem is these are global markets, and globally, if you have a fairly high price of oil, which is what we've had, and you have tremendous advances in technology, you're going to see more oil come on. I certainly don't agree that the day after a Kamala Harris election that we would see oil and fossil fuel dead. I think the more likely thing is that we're going to see much more modest prices next year, and we'll see oil trade a lot in a lot quieter terms than we have for the last 3 years. Ukraine war, the COVID lockdowns and so forth. Those are the big things that shaped oil prices in the last 4 years.
Yeah, our own Ben Workshall, our Washington correspondent, calling it one of the few substantive policy exchanges during the Tuesday night debate and talking about oil and the energy sector here. Tom, thanks so much for taking the time here with us to break down all things oil and the energy sector.
Thanks for having me.
Appreciate it. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. Now, time for a closer look at some of the top trending tickers moving the market here. Yahoo Finance makes it easy to track the best and worst performing stocks of the session with our trending tickers page. You can scan the QR code on the screen to connect to our site and check out the latest. And let's check out a closer look at Yahoo Finance's trending tickers. 3 names to watch. First of all, we've got Manchester United, then we've got Dave & Buster's, and then Rental Kill. That one's going to be a new one for you. But first, let's go to Manchester United here. 30 seconds on the clock. Taking a look at shares, they're down by about 8% right now. Man U moving lower following the earnings release. The club posted a 5th consecutive year of net losses here. And there you're taking a look at shares of ticker symbol conveniently titled MANU, down by about 8, almost 9% here within the release here. And I only have about 10 seconds, but within the release here, one of the things that they also mentioned, total revenues contributing to what they said was a record 2024 total revenue driven by record commercial and match day revenues. All right, I didn't make it.
Did you make it?
No, I didn't.
No, I was gonna say, from when you said that you had 10 seconds, it sounded like a lot more.
Yeah.
It seemed like a lot longer. All right, let's take a look at Dave & Buster's moving higher after the company posted higher profit and revenue during its fiscal second quarter, looking at gains of just about 7% that jumped to the upside. We had seen shares up as much as 17% earlier in the trading day. It was actually the biggest intraday move to the upside that we've seen since June of 2023 in just over a year. But we are back below those highs. When it comes to these results that we are getting from Dave & Buster's, William Blair saying that it did overshadow softer than expected comp sales during the quarter there. So a bit of weakness there for Dave & Buster's. But again, the street looking at this through an optimistic lens.
Yeah, I got to work on that company's IPO. Exciting times. All right. Also, shares of Rent-A-Kill, and we said this one would be a new one for you, plunging down nearly 20% after the pest control business warned that a slowdown in its North American market will hit profits over the second half of 2024. Shares right now, they're down, about 20%. They clearly haven't done much research into the total addressable market here in New York City, because otherwise they would find plenty of pests and rodents to go after. But ultimately here, we'll see how they're able to turn this business around.
All right, we'll keep it right here on Yahoo Finance. We're just getting started. Coming up next, what does this morning's inflation data tell us about the Fed's path forward? We're going to dive into that next on Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. 30 minutes into the trading day. We've got our eye on three catalysts impacting markets today: moderating inflation, the fiery presidential debate, and the market's reaction to changing election odds.
Well, inflation coming mostly in line with expectations ahead of next week's Fed decision. However, that monthly core number was slightly hotter than analysts and economists expected here. Traders now leaning firmly away from the probability of a 50 basis point rate cut.
And a fiery debate between former President Donald Trump and Vice President Kamala Harris had the two facing off on the economy, immigration, and Middle East tensions. The betting markets now have Vice President leading after initially starting at near even odds.
And we're seeing this fallout from the debate impact markets. The so-called Trump trade took a hit. DJT shares sinking. Bitcoin also moving slightly lower earlier. We'll see exactly where things are netting out right now, as it has been oscillating between gains and losses over the past 24-hour period. And then on the other side of the aisle, you've got solar stocks seen as potentially doing better under a Harris presidency, all rising right now. We'll dive into the best election plays later on this hour. But first, today's CPI print showing prices are moderating. This is one of the final key pieces of data that the Fed is getting before making its decision on a potential rate cut next week. Here with the three things this report signals about the Fed's path forward is our very own Jennifer Schonberger. Hey, Jennifer.
Hey, Brad, indeed. One of the last pieces of data and that fresh reading on consumer prices this morning likely to keep the Federal Reserve on track to cut rates by 25 basis points next Wednesday. Consumer prices coming in lower on a headline basis and holding steady on a core basis for the month of August. Looking at those numbers specifically on a core basis, excluding volatile food and energy prices, those increased by 3.2%. That was in line with expectations and holding the same level as July. So what does this say about the Fed's path forward? Well, first, this data underscored that inflation continues to move down slowly. And a large reason for that is housing. You look at the data for today, the index for shelter rose 0.5% for the month of August, and that was a major culprit in keeping inflation elevated. This data taking odds of a 50 basis point rate cut off the table. Indeed, take a look at Fed funds futures this morning. Investors now betting on a 25 basis point rate cut, now at 85% odds, I should say, risen on the back of this data. Now, all of this said, this was the fifth straight report of good inflation. Recall back in the first quarter, inflation looked like it was stalling, and Fed officials had said that they need more than a quarter's worth of good data to cut rates. And if you look at the trend of inflation data, indeed, over the past 5 months, we are seeing that. Now, second, while the Fed has been very focused on inflation, now that it's showing signs of coming down, officials have made clear that they are more focused on the labor market. And if we looked at the jobs report for the last month in August, it did not warrant a 50 basis point rate cut. That said, you look at the revisions for July, which was already weak, along with June, and they were bad. So if we see further deterioration in the job market, then that could cause the Fed to cut by larger increments. Finally, given the path for inflation, given that the job market is cooling but not in a recession, and that the economic growth is perhaps slowing but not contracting, that likely keeps the Fed on track for 3 25 basis point rate cuts for the remaining policy meetings for this year, including next week's. Guys?
All right, Jennifer, thanks so much for breaking that down for us. Well, this morning's inflation report showing prices are moderating near their lowest level in 3 years, but core inflation coming in slightly hotter than expected, and that's tempering a Fed rate cut expectations. Joining us now, we want to bring in Daniel Hornung. He is the Deputy Director of the National Economic Council. It's great to talk to you here. So let's just get your reaction to this latest inflation print. Yes, it is an improvement. We talk about the fact that the headline number down to the lowest level in 3 years, yet Wall Street taking a bit of an issue with that hotter than expected core component, Daniel.
Well, it's great to be with you. You know, we think this is a good report. As you mentioned, inflation down to its lowest level since February 2021. Under the hood, if you do things like taking out housing, you actually see that core CPI without housing is below 2%. So we really are at a point in this inflation cycle and this business cycle where the focus now is on sustaining the critical progress that we've made over the last years for American workers. The president, the vice president have spoken to their plans to do just that, to do things like try to cut taxes for working families, for middle-class families, to reduce the deficit by making sure that the wealthy and large corporations are paying their fair share. So this is an encouraging report. We think the focus is on sustaining this progress, creating jobs, growing the economy, and the work ahead from there.
So let's talk a little bit more about that and the upcoming election. And you were starting to get into it and what they were discussing in last night's debate. You heard former President Donald Trump and Vice President Kamala Harris both touting their economic plans. I want to play for you a clip of what they had to say and then get your reaction on the other side.
The best economists in our country, if not the world, have reviewed our relative plans for the future of America. What Goldman Sachs has said is that Donald Trump's plan would make the economy worse. Mine would strengthen the economy. What the Wharton School has said is Donald Trump's plan would actually explode the deficit.
I went to the Wharton School of Finance, and many of those professors, the top professors, think my plan is a brilliant plan. It's a great plan. It's a plan that's going to bring up our worth, our value as a country.
Daniel, as a White House advisor, how do you view both candidates' economic policies here? You know, entirely understanding that you've also had to study through both administrations' outcomes over the past 8 years, in essence, as well.
Well, I need to be careful and not comment on the campaign from here. What I can say is that the president and the vice president now have put forward a series of plans that would really address the key needs facing this economy right now. Would do things like, as I mentioned, cutting taxes for working families, but reducing the deficit by asking the wealthiest Americans and the largest corporations to pay their fair share. Really investing in building more housing in this country to help bring down housing costs, a key pain point facing families across the country. And when you look at the contrast here and comparing that against the alternative that's being offered by congressional Republicans, for example, you see plans that would do the opposite, would cut taxes for billionaires and large corporations, would impose a national sales tax that would drive up costs for middle-class families. So there's a very clear contrast on the economy. And we think that the plans that the president, that the vice president have put forward would really help grow the economy, strengthen the middle class.
Daniel, what's your assessment of the economy as it stands right now? There has certainly been some focus, more and more focus on the softening labor market. Is that at all, do you think, a risk here of leading to recession?
Well, I think we're in a resilient place in the economy right now. We've seen sustained job growth, the unemployment rate remaining at a historically low level. I do think, though, that as we've really seen this decline in inflation from more than 9% to 2.5% today, the focus is shifting to sustaining the progress that we've seen in the labor market. There's no question that is the key question facing the economy right now. And so we continue to monitor the labor market closely. And I think as we look to build on the progress that has been made, the focus should be from all policymakers on what we can do to strengthen the recovery, strengthen American workers, strengthen the labor market.
You know, it's interesting, and I was reading through a Workday report this morning, and they were specifically within this global workforce report talking about a few factors that really allude to how much the labor situation and broader, the types of jobs are going to change pretty drastically over the next 4 years to 8 years as well. With all of that in mind, how could that factor in and eventually start to show up in the employment situation and the numbers that the Fed is paying close attention to?
Well, as we look to the medium term, there's no question that we need to be, as a country, investing in workforce training, investing in education, investing in our people. We need to make sure we have a tax system that allows us to have the fiscal space to make those key investments. We've already seen under this administration investments to really help us win the industries of the 21st century, from chips and technology and semiconductors to clean energy. We need more of that approach. We need to really make sure that our economic policy is geared not just towards the moment and getting through the moment, but instead 5-10 years down the road what can we do to make sure that American industries are winning global competition and American workers continue to have good quality jobs that are leading to higher living standards.
Daniel Hornung, who is the National Economic Council Deputy Director here. Thanks so much for taking the time here with us this morning.
Great to be with you.
Well, let's talk about the market's reaction to this morning's inflation report. We've got all three major averages under pressure right now. The Dow is down by about 1.5%, 590 points in the red. You're also seeing the S&P 500 down by nearly 1%, and the NASDAQ composite, that's lower by about 0.4%. We'll round that off too. Markets have been rocky since economic data has begun sending some mixed signals about the health of the economy and where the Fed finds themselves right now as they are setting out to initiate their cutting cycle in September here, as that is what we're expecting and what's priced into the CME Fed Watch, as traders are now pricing in an 85% chance of a 25 basis point rate cut at next week's Fed meeting. But will that be enough to ease market jitters? Joining us now, we've got Mark Malik, who is the Chief Investment Officer over at Siebert. Great to have some time with you here this morning. So if 25 basis points is the reality, why, for markets that have been already pricing that in to a certain extent, why are we seeing this type of reaction from your purview?
Yeah, the numbers came in as expected, and the market's reaction to this morning's number really just shows that, the markets were secretly expecting or possibly even hoping for some more. And so the fact that the numbers came in pretty much on the laces and essentially eradicated any potential that the Fed is going to do one of those surprise 50 basis point cuts next week. You're seeing the reaction as we speak, not only in the stock market, but also you saw two-year note yields react initially pretty quickly. So bond traders as well were hoping for something a little bit juicier.
When it comes to what we are seeing play out within the market, you talk about the reaction there. There has been some debate about 25 versus 50. It looks like 25, it seems to be overwhelming consensus following this report. What is that? Is that 100% priced into the market at this point? And then I guess, therefore, what is the market expecting? What are you expecting from the Fed beyond September?
Yeah, if we look at this morning's numbers, and we got nothing between now and the end of the year, I think, the path is 325 basis point cuts between now and the end of the year. Unless we see anything crazy coming out of the labor market, which we very much could in the upcoming months, there's not a real incentive for the Fed to rush and front load this, right? It seems like the smartest direction for the Fed, given what we know today, given the fact that we are in an election season and there may be some policy changes coming up, the path of least resistance seems to be the most conservative path at this point, which is 325 basis point cuts. And I think the conservative part of the market is sort of betting on that. Of course, there's always hope for something exciting to spur the market on the upside. But, we're focusing on our base case is 325 basis point cuts between now and the end of the year, given what we know today.
To this juncture, that exciting catalyst or that spur that you're talking about had really been this theme of generative AI. What is the next catalyst or what is the next big spur for the markets that you anticipate will have some type of major delta or impact in the price action we've seen more broadly?
Yeah, well, I hate to bring it up, but we are in election season, and it seems like even based on the numbers that we see this morning, the two candidates are neck and neck, and so there's still a big layer of unknown for the market, what to expect. And beyond the presidential election, a lot of people are not focusing enough, I believe, or we believe, on the Senate races, and those are really going to determine tax policy more so than the president. So we're going to focus on that. So I think, again, the market having a better, clear picture of what that's going to look like as we get closer to November, I think that is going to be certainly one catalyst. And of course, we have corporate earnings that will be coming out, relatively soon, and we'll be watching those things to see if there's a continuation of the last earnings season as well.
Mark, we got to leave things here on the day. Mark, thanks so much. Mark Malik, who is the Siebert CIO. Appreciate the time.
Thank you so much.
Certainly.
Let's take a look at the markets here a little over 46 minutes into the trading day. This market check sponsored by Tasty Trade. Take a look at the major averages, all trading to the downside. You got the S&P off just over 1%. The Dow, the worst performer of the three major averages there on your screen, off just about 1.5%. Flipping over to the bond market, Treasury yields pushing higher on the day. A bit of a reversal from some of the momentum that we've seen with energy prices. You got yields actually now moving to the downside there, reversing some of that earlier move to the upside, right around 364.
And let's take a look at the dollar as well. It's getting a little bit of a bid. Traders pricing in a 25 basis point cut at the Fed's meeting in September, the 17th and 18th. And then additionally here, we're watching energy stocks after last night's debate. Energy sector was one of the core or substantive parts of the conversation that had some policy around it here. Energy right now, the XLE, you're seeing that down by about 1.9%. But if you were to take a look at some of the energy stocks that we've been tracking here, pre-market, they were all handedly up here. Some of the largest market cap ones, NextEra Energy, First Solar, Enphase, they were all rising. We'll see exactly what those do throughout the rest of today's trading activity. But XLE as a whole, and look into the sector, it is down right now by about 1.9%.
All right, we'll keep it right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Now time for some of today's trending tickers throughout the trading day. You can track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. Scan the QR code below to check out the latest. Warren Buffett's Berkshire Hathaway is selling more shares of Bank of America, reducing its stake in the bank to 11%. Now, Berkshire now has sold Bank of America stock for 12 straight trading sessions. Shares are relatively flat right now. When you take into account what they have shed, at least over the last couple of trading sessions, they shed a total of 5.8 million Bank of America shares in separate sales. That was on Friday, on Monday, and Tuesday here for almost 228.7 million. The average selling price of $39.45 a share. That's according to that new regulatory filing. The latest action here extending that selling streak of the 12 consecutive sessions that had matched the 12 consecutive sessions from July 17th through August 1st. So again, just unloading more. It's another day. We're talking about the same thing.
Yeah, I mean, if we're looking at where he's ultimately selling some of the Bank of America position here, the Berkshire Hathaway firm has been so good at dollar cost averaging that even as you're looking at the profits that they are taking and the latter step down that we've been watching since July in the share price action, every time we get more of the details about how much they've been sharing and selling and at what pace they've been selling, the dollar cost averaging economics, I imagine, continue to play themselves out in Berkshire Hathaway's favor. And at this juncture, even if you were looking at and hearing from some of the people that we've had on the program talking about where XLF and particularly financial sectors could catch a bid, even as we get into the cutting cycle here, I think that's where we might see even more of the activity around Berkshire Hathaway, who's been known to chart forward where it's buying into certain positions based on the larger economic cycle and where the cutting could play well into financials more broadly. Wouldn't be surprised if they continue to keep a certain amount on the table and then buy back in at a certain point. We'll see if they do so or if they rotate into some of the other sexier elements of the market here, given that they've been or had been historically late to tech for a while, but now Apple, one of the more outsized, largest positions that they have. Also, let's track shares of Williams-Sonoma this morning, jumping after an upgrade from Jefferies. They are now saying it's a buy, and it formerly was a hold. Jefferies said the company has hidden gems, wow, in its portfolio and can benefit from a modest recovery in the housing market here. You're taking a look at shares of Williams-Sonoma, WSM. They're up by about 1% on this. Yeah, you know, I just think back to what we had seen within the...
you don't seem sold.
I'm not sold right now, but only because I'm thinking about the data that we saw in the BLS, not the BLS report, the CPI that came out this morning, and really looking specifically at some of the home element of that, home furnishings. That continues to be a weaker spot, and I think that's a headwind that Williams-Sonoma is going to have to continue to navigate through, at least until we see some type of pickup more broadly in the homes market as well here, because that's where you get the replenishment rates start to come back into the realm for a lot of buyers out there.
You do, but then you can also make the argument, though, more people staying within their homes that they're then remodeling.
That they just want to refresh?
And they're refreshing, so then they're going out and spending more money at a West Elm or some of Williams-Sonoma's other types of brands, so then that could offer a boost there if they aren't moving. But I thought Jefferies made some good points within their report here. They're talking about the outperformance of Williams-Sonoma relative to other brands within the space. More specifically, they talked about West Elm Kids brand. Do you know about that brand? It's pretty good. Well, it's actually poised to double in the coming 3 to 4 years. That's from Jefferies' expectations. They also talk about rejuvenation, the recent debut in Canada. They see that as a catalyst here for the stock going forward, and saying that they're raising brand awareness, which I think is going to help with some of that momentum.
So
Did
family
help sell
formation.
you a little bit?
Family formation is what they're
Exactly.
banking this on. Okay.
Yeah.
All right, you kind of sold me.
Let's take a look at Starbucks. Their new CEO, Brian Niccol, officially starting his role this week. In an open letter, he outlined his vision for the company and how he plans to spend his time addressing some of those key issues that Yahoo Finance's Brooke DePalma has been closely tracking for us. Hey, Brooke.
Good morning to you both. That's right. Brian Niccol coming out with this letter. It's called Back to Starbucks. And what he's really looking at here is getting that business back to the core, back to the coffee that it's known for. In this open letter, he said that he's been a long-time customer. And since his announcement was made in mid-August, he has been spending time in stores as well as with employees. But he was not shy to immediately jump into the key issues that the coffee chain faces. In the open letter, he said that there's been inconsistent product, that wait time times has been too long, or the handoff from the barista to the customer has just been too hectic. He also said that the company needs to elevate the in-store experience. They want to move back to that. Well, he didn't say exactly, but it really sounds like that third place that founder Howard Schultz really envisioned, a comfortable place for people to go and grab Starbucks, hang out, and do homework, essentially. They said they also want to identify where is a clear place to pick up those mobile orders. Often, analysts have pointed out that it's confusing for consumers when they walk in and they want to grab that Starbucks, where they should go and if their order is ready or not. In addition to that, Brian Niccol really looking to implement key strategies that were successful at Chipotle when it comes to partner, what Starbucks calls its employees' relationships, really looking to provide career opportunities and a place to grow. We know that retention, as well as the relationship overall between leadership and its employees, has been a bit of a tension point over the past few years. And these were awfully similar to what we heard from former three-time founder and CEO Howard Schultz back in May, when he said that the issues in the U.S. need to be fixed first. There needed to be an overhaul of the current strategy, and it needs to go back to coffee-forward innovations. Of course, Brian Niccol, he's known to introduce throughput. He had a dual-sided grill at Chipotle. He hinted at investing in technology at Starbucks. But when you think about store count from Chipotle to Starbucks, this is a much bigger playbook that he's now in.
Don't bump that, Brooke. Look, at the end of the day, I just want to hear more about the unicorn frap. Like, you could easily come out and say, you know what, we're going to lean into like the whole Barbie-corification of drinks that we had seen over the past couple years now. And I know that's kind of fading here a little bit. And Corp-Core, I think that's the new thing. But at the end of the day, I want to hear more about where they're expanding beyond coffee. It's good
What do you
that
want
he's
to
getting
see?
them. Just, look, bring back the unicorn frap. I want to see that. I want to see
Unicorn frap, the answers to Starbucks' issue.
Look, you easily could have won me over with that. I also think that, look, in other times of the day, because you have people spending more time there to study, more time there perhaps in the later evenings.
The afternoon day part has been something that has been
That's a
off
weak
for
spot.
them. But also, too, when you think about Brian Niccol's key advantage here is that he is a marketer at heart. And that's something that Starbucks has thrown all these new instructions, the boba and the energy drinks and the lavender. And when I spoke to one analyst, they were saying, hey, were the products good? Yeah. Did they market them well? No. So people didn't really know about them. They weren't really enticed to go. We know that this is Brian Niccol's strong suit. He knows how to get people in the door.
He's good with LTOs, the limited time offers.
Very
as well.
good.
Yeah, we'll see how that comes to fruition. Maybe some unicorn fraps. Brooke De Palma, thanks so much. Appreciate it. All your markets action straight ahead. Stay tuned. You're watching Catalysts.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step
Well, this morning, CPI print giving another data set for the Fed to consider before its meeting next week, where policymakers are widely expected to cut benchmark rates in anticipation of what bond traders are already seeing as slowing jobs growth and inflation. 2- and 10-year Treasury yields are tracking in 15-month lows. We are seeing the 10-year yield pull back just a bit. We initially saw actually a move higher on the heels of this print. Here with that and more, we want to bring in our next guest. We have Ella Hoja. She is Newton Investment Management's head of fixed income. Ella, it's great to talk to you here. So first, I guess, help me make sense of the bond market reaction that we saw here today on the heels of the CPI print. We initially saw that move higher in yields. Now here we are pulling back just a bit.
Well, the first take is that bond markets have got accustomed to seeing lower inflation prints of late. And so typically an inflation print that's in line to slightly higher is probably seen as tiny hawkish surprise. I mean, I don't want to overplay it, but, that's one explanation for the initial reaction. But as we can see, the price action is reversing, and we've seen quite a bit of that over the course of this week and also last week in the face of what has been a very busy supply period for bond markets, particularly on the corporate sector side. And so I would judge actually price action as quite healthy for bonds, certainly for the bond bulls out there.
And so what type of duration should some of the bond bulls be looking towards right now?
Well, the biggest sort of high Sharpe ratio trade, if you like, or beneficiary position for bonds has been in the front end of the curve. So 2-year maturities, they've done very well in terms of rallying hard, and we've seen some steepening of the curve. So 2-year bonds outperforming 10-year bonds. And we've seen what is an important pivot point, I guess, for bond markets, and that's the uninversion or disinversion of the curve, the 2s, 10s part of the curve. And so typically that tends to signal that we're headed into a potential slowdown in the economy. And so that would usually favor the front end of the curve, so short maturities.
And Ella, do you see that as a trend that's likely to continue here over the next several months, given some of that uncertainty?
Yes, and that's been corroborated by the data. So it's been pretty persistent. It's been going on for several months now. And we're definitely in the camp that believes we can see the curve continue to steepen further. And we are watching very closely the jobs numbers, which have been, particularly some of the more leading components of the jobs numbers have been flagging a slowing of the economy. And we're certainly more on the camp that believes growth will surprise on the downside towards the end of this year or beginning of next year.
So with that in mind, how are you kind of correlating the steepening of the curve to the risk of hitting a recession or even a harder landing?
Well, certainly relative to market expectations, we think we can surprise on the downside. And I think that's what the jobs numbers are telling you. It's still early days. I think we need more confirmation, but the trend has been in play, I would argue, probably since April at the very least. And this is when we started to position for this view. I think, again, as I say, we need more confirmation of this thesis, but you can see the nervousness creeping in markets, particularly as what the curve's telling you and what commodities are telling you is that we are heading for this slowdown. But credit markets and equity markets haven't so far agreed. I think we're tentatively seeing signs that might be reversing, and therefore it's quite an important time in financial markets as far as this year goes.
So Ella, here we are for the 10-year yield just below that 3.7 level. Where do you think that likely trading range is going to be here, given that uncertainty over the next several months?
Well, certainly on the downside. I mean, we have elections in November, so that certainly complicates things a little bit for treasuries. But we can see if indeed this view that we're going to get a much a more meaningful slowdown, I would say. If that gets confirmed, then we can certainly see perhaps at least another 70 basis points or so rally from here. But we can always overshoot. I mean, it's the nature of markets that they tend to overshoot. So depending on the size and magnitude of that slowdown, if confirmed, we can also go towards sub 3% or even 2.5%.
Ella Hocha, who is the Newton Investment Management Head of Fixed Income. Thanks so much for taking the time here with us.
Pleasure.
Coming up, with the presidential debate now behind us, where does the race stand with less than 2 months until Election Day? Stay with us.
The presidential debate last night covering a wide range of topics concerning everyday Americans, including the economy, inflation, healthcare, and immigration. But for still undecided voters in swing states, did either candidate do enough to hammer home their policy promises and sway opinions? Here to discuss that and the state of the race with less than 2 months to go, we want to bring in Tom McLaughlin. He's UBS Global Wealth Management Election Watch co-lead, and sorry, a mouthful there when we go through your title. Talk to me about last night, because when you take a look at the market's reaction, yes, we did see a bit of a reaction in the dollar, although much of that fading on the heels of the CPI print. Is there anything last night that you think was significant for investors to latch onto?
Well, there's very few undecided voters left. So both candidates were pitching to make their play with the 2 or 3% in the 7 pivotal states that will make the difference. Did it help Vice President Harris? Yes. Is it going to last? That's the key question. I think she comes out of the debate with momentum that she's effectively restored, which she had initially when she got the nomination, and then it kind of plateaued. So she probably in the next week is going to see more momentum. It probably did help her a little bit. The real question is, in a week, will the undecided voters who might have been shading towards her basically think again?
Is it clear what the top issue is for those undecided voters?
Well, it depends where you are and who you are. It's going to be reproductive rights, its border, inflation. But inflation, I think, as a campaign platform, is probably dissipating just a bit. So it comes back to the things we've been talking about for 6 months. It's the border, it's reproductive rights. The economy is always going to be important. I think the last time we had spoken, there's a lot of research out there that suggests that Americans tend to vote for the president they believe is going to help them on the economy. And that's been true for 50, 60 years. To the extent that the inflation rate is basically, we saw the print this morning, it's coming in pretty much as expected. Inflation is becoming less of an issue. Now, there's a 6-month lag. Here's the other thing. When you see an inflation number come down, it tends to take 6 months And this is a lot of research suggests that it takes that long for individuals to appreciate the fact that the inflation rate is not what it was half a year ago.
Tom, how have your conversations changed with your clients just as we have seen the polling between Harris and Trump be so close? And then I don't know if you had the chance to speak with Blanchett this morning, but on the heels of her performance last night, when we did get maybe a slightly better sense, although it wasn't very concrete in terms of policy initiatives, but a better sense of what a Harris presidency could potentially look like.
In terms of what the polls are going to react to? So polling in the presidential election years has been tricky. So if you look at the accuracy of polls, in 2016 to 2020, we know they were not particularly accurate. They underestimated Trump in 2016. They overestimated Biden. He still won, but he won by a much smaller margin. But in 2018 and 2022, they were actually quite accurate, which leads you to believe, or at least speculate, that one of the issues with polling has been that Donald Trump brings people out who otherwise have never voted or will not vote in any other election, but will vote for the former president. And so when you think about the impact of polls, you have to keep in mind that this is an unusual candidate. He has the ability to bring out voters who otherwise would not be active participants in the market and basically say, I'm going to vote for the former president. And that makes it very difficult for pollsters to really bring in accuracy to the level that we had seen prior to 2016, and we still see in the midterm contests.
One of the issues that came up numerous times was fracking, which is actually important to a swing state like Pennsylvania here. I want to take a quick listen to what the two candidates had to say and play that, and then get your reaction on the other side here.
Do you believe in things that the American people don't believe in? You believe in things like we're not going to frack. We're not going to take fossil fuel. We're not going to do things that are going to make this country strong, whether you like it or not.
I will not ban fracking. I have not banned fracking as Vice President of the United States. And in fact, I was the tie-breaking vote on the Inflation Reduction Act, which opened new leases for fracking.
And so we have an excellent write-up on Yahoo Finance right now from our own Ben Werschel, who mentions within his headline, did Harris just join the all-of-the-above energy club here? And I think that's the perfect
That's a great way to put it.
Question to put to you here, Tom.
Yeah. So to some degree, I think what we saw is that the vice president had tacked to the left 4 years ago when she was running for president, and she's trying to back away from some of those positions. She was very clear, and I think she has to be clear if she's going to basically win Pennsylvania, which is the most critical state of the 7 that are in play. So the president, meanwhile, was basically trying to reemphasize the fact that she going back now 4, 5, 6 years, was a bit more progressive than she's basically portraying herself now in the presidential election. So they were both basically following the script they went in with. I mean, when you think about presidential debates, we're always remembering, the clever rebuttal, the soundbite that everybody's looking for because it gets replayed on social media constantly. So they each had their talking points and they wanted to drive those home. That's what you saw in that clip. And I think the vice president did a reasonably good job of basically making it very clear that her position today is that there's no banning of fracking.
We also heard a little bit more about their plans for tariffs. We've heard a lot from the Trump side. It's something that came up in the debate last night. Let's play a quick bite from that and we'll get your reaction, Tom, when we come back.
China was paying us hundreds of billions of dollars, and so were other countries. And, if she doesn't like them, they should have gone out and they should have immediately cut the tariffs. But those tariffs are there 3.5 years now under their administration.
You want to talk about his deal with China? What he ended up doing is under Donald Trump's presidency, he ended up selling American chips to China to help them improve and modernize their military. Basically sold us out when a policy about China should be in making sure the United States of America wins the competition for the 21st century.
Tom, the far-reaching tariffs that we've been talking about, both sides have really been talking about, is that shaping up to be, obviously under a Trump administration would be a little bit more, but is that shaping up to be one of the biggest risks to the markets?
Yes. So in a Trump administration, you'd see tariffs be applied very broadly. In a Harris administration, you would see tariffs basically put in place, but they'd be more targeted. And the challenge here is that tariffs are inflationary, full stop. This is not a debatable point. But when it goes in, what happens if you have a broad tariff versus a targeted tariff? In truth, yes, the Biden administration did not roll off most of the tariffs that Trump had put in. That was basically directed primarily towards China on national security grounds. You'd see more of that under a Harris administration.
Tom McLaughlin, always great to have you.
Yeah,
Thanks so much
good
for
seeing you
joining
too.
us back here on set. We hope to have you back again soon. UBS Global Wealth Management Election Watch co-lead. Thanks so much, Tom.
Thanks.
Shortly after the end of the debate, Taylor Swift took to Instagram to formally endorse Kamala Harris last night, calling the vice president a, quote, steady-handed, gifted leader. What kind of impact, if any, could her endorsement have on the election? For more, we want to bring in Yahoo Finance reporter and resident Swiftie. Rick, you're a Swiftie? I didn't know about that until this intro. Rick Newman. Rick, let's talk about the significance of this. Clearly, Taylor Swift has a massive, massive following, not just in the U.S., worldwide. How significant is this endorsement?
Well, if you were going to pick one single person in the United States whose endorsement you would want, I think it would be Taylor Swift. I mean, she has 280 million Instagram followers. That's almost equal to the entire population of the United States. I mean, think about that. So is this going to be decisive? Not necessarily. And I think it matters whether it's just this one endorsement and then she stays quiet, or she somehow sort of actively campaigns for Kamala Harris. Now, she did say in that endorsement, she basically said, I'm not telling anybody else whom to vote for. You have to do your own research and make your own decisions. But the hint was there. So is this it, or is there more to come from her? And I think that's pretty important. I did ask, so I'm not a Swiftie, but I have a 27-year-old daughter who's a Swiftie. So I'm a Swiftie by extension, I guess. And I asked her this morning, I said, do you think this will make a difference? Do you think more young people will actually vote? And she said, yes. She does think that it will get more people to think about voting just because this is Taylor Swift's moment, and she is just so hugely popular at the moment. And I would point out, people under, let's say, 18 to 34, turnout in 2020 among that group was about 57%. That was the lowest of any age group. So what Kamala Harris wants is she wants to push that number up. She wants more young people to vote. They do vote overwhelmingly Democrat. And if we can get higher turnout among young people, especially in the 7 key swing states we're talking about, yeah, I mean, anything that gives any candidate a marginal advantage in this election is extremely welcome by that candidate.
Yeah, really sad for me to think about, Rick, the fact that I was actually counted as part of that percentage in the previous election, and now, because of aging, I'm no longer counted as part of that here. So that's a realization.
Get used to it, Brad.
For me. I know, but all these things considered here, where could we see other key support line up? We've talked about some of the CEOs that have come to the support of Harris. We've also kind of lined up some of the very instrumental endorsements, such as that from Taylor Swift. Are there others out there that could swing the needle one way or the other here more broadly and have an impact on the election?
So this gets to the whole question of the relatively small portion of voters that Tom was talking about who remain undecided. The portion of voters who remain undecided is not trivial. Even if it's only 5%, that's the margin right there in all the swing states. But in addition to those undecided people, don't forget about turnout. I mean, getting people to vote who support you is a huge issue. And that is one of the things the prior guest was talking about. Trump manages to boost turnout among people who might not otherwise vote if Trump were not on the ticket. Kamala Harris needs to do the same thing. So young voters, she needs to get more men in her camp, and she needs to just work harder just basically camp out in Pennsylvania and use the reproductive rights issue to get people motivated there. So she's going to win women voters. She needs to boost male voters on her side. What if Travis Kelce, Taylor Swift's boyfriend, says, hey, I'm with Taylor, vote for Kamala? Maybe that would be something that might help. But, you always want the young people to come out.
Yeah, that'd be a tough conversation if he went against her, I guess. Rick, thanks so much. Really appreciate it. A lot we're going to be tracking going into November. Appreciate it.
Bye, guys.
All your markets action straight ahead. Stay tuned. You're watching Catalysts.
Yahoo Finance is continuing its coverage here in San Francisco at the Goldman Sachs Communacopia Conference. Let's focus on the business of telecom. AT&T CEO John Stankey back with us. John, good to see you again. I have not seen you since the Invest Conference of last year, so welcome.
It's good to see you again, Brian. Nice to be back with you.
Likewise. So I like when you reported your earnings, you had your conference call, and you're like, we're going to talk about something called Gigapower in a few weeks at the Goldman Conference. You talked a little bit about it. What is Gigapower, and why is fiber so important to the AT&T business here?
Well, Gigapower is a way for us to extend the great fiber that we're building in our region, in our operating footprint, outside of it, and to use a partner to do it. So BlackRock is interested in investing in infrastructure. They saw a capable operator in our case. We came together, we put together a management team, they came with some financial backing, and we're now extending fiber outside of what used to be our traditional operating footprint. Allows us to go faster, build more homes. It's a shared risk model, shared return model as a result of that. It's a way to get the AT&T brand deeper out into the United States. And when we do that, when we get that fiber in place, it actually helps our wireless network because we got customers who want to buy both fiber and wireless together. The fiber product's so good, it elevates the capabilities of the brand in the market as a result of that. And it's really proving to be a pretty good model for us.
Is that the converged strategy you've been talking about? Because a lot of folks on the street are giving you high marks for focusing, I guess, both on fiber and the mobility play.
Yeah, I think we're at the front end of the converged strategy. The converged strategy today is a household that buys both fiber and wireless from us. When they do that, they churn less. They have greater lifetime value because of that. Their brand affinity goes up because they like the products together and the convenience of using them. Call it the second, third inning of converged is going to be, do the products work better together? And you're going to start to see that happen. So we're beginning to introduce, for example, wireless backup. So when your primary broadband connection goes out, we can roll it to wireless in the background until we fix it. Those kinds of things in that roadmap will ultimately add more value to the customer and give them more reasons to buy products together. And that's really what I see as kind of the next transition of converge.
How does this change the financial complexion of AT&T? I mean, more services, can you take some price?
Well, look, if you're offering a better product and you're offering better value, you should be able to command a premium on it. And the reality is right now, because we're penetrating and taking share, for example, in our fiber product, even though folks will tell you that it operates better, they have a higher affinity for it than any other offer in the market, it's a great product, but we're still selling kind of underneath what other people in the market are selling, which bodes well for the future because after you get the customer, you bring them in, then you can obviously price to market, and we'll do that over time. But look, I think the important thing is if you have the best product in the market, people see it that way, they're just going to stick with you and have a lot of loyalty toward it.
Does Verizon's play for Frontier, $20 billion, does that change the operating dynamics in the industry?
It doesn't change it for us. We're going to continue running the plays that we put in place, which is largely organic investment, for us to look at places where we can go in and build in our footprint where our brand does incredibly well, build it on a model. It's the same operating systems, the same infrastructure. Then when we do Gigapower, we go out and we build in places where it will help lift our wireless business so we can be very strategic around where we want that footprint to go. And I like having that optionality. I like being able to control it ourselves. I prefer not to have to go ask regulatory permission every time I go do something. And by having that internal, for us, it's a good thing to be able to have those choices.
I remember last year when we had this conversation, and I can't believe it was a year ago, we talked a lot about Apple. I guess the iPhone last year was okay. I got an upgrade, but this year they did hint at more AI type of products. Does a new iPhone really move the needle at this point for an AT&T?
We'll see. I mean, we're going to find out whether it moves the needle for Apple. I mean, whether it's this version of the iPhone or the previous version of the iPhone, what we care is that there are phones out there connected to the network. That's kind of where we make our money, and we're kind of less focused on the particular version of the device that we see. But look, I think what we're going to see here is I'm maybe less of a viewer that there's going to be a big bang. Big bangs come like when we go from 4G to 5G and there's a new air interface and the phone's going to perform dramatically differently because of that. software tends to be more iterative as opposed to hardware, and Apple has been a hardware company with a great software experience on top of it, but there are software features, I think, over time, they gain momentum as they get better and as people understand the use cases. Maybe we see that same thing with AI, that it's going to take a little bit of time for customers to understand how they use it, how they employ it, gain some affection for it. But I think software is great because it doesn't require you to spin hardware all the time. You can constantly introduce new releases at any given time. It iterates every couple of weeks. It can be a very powerful model. It's just less of a bang.
Yeah, everyone that I've talked to here so far, obviously the focus is so much on AI. You have Apple with AI products, Microsoft, Google, they're all doing amazing things. Does the AI revolution change? Will it change AT&T, and if so, how?
Oh, I don't want to overhype it, but I think if you go back to 1998, you're too young to remember that. But
I was born in 82.
Yeah, go back
I remember.
to 1998.
Come on, I know I look great, but I mean,
we were all sitting around saying, "What's this thing called the internet?"
Yeah.
And the internet bubble, it burst, everything was overhyped. Well, I think we sit here today, 25 years later, we probably don't say, "Well, the internet was overhyped." It fundamentally changed industry. It fundamentally changed how business models were structured. I think AI will have that same impact. It won't take 25 years for it to occur, but we're at one of these moments where we're at the front end of it. 10 years from now, we're going to say, what was life before AI? And so I think it's going to be hugely impactful, and it's going to be impactful to my business, how we operate it, how we support customers, how we engineer our products and services, how we price things, how we build product on top of the network. Those are all going to be meaningful things for AT&T. It will change us, and it will change every other company.
First, thanks to John Stanky and Brian Sazi for bringing us that interview.
All right, everyone. Well, coming up, where Catalyst ends, wealth begins. Dedicated to all your personal finance needs. What? This is serious business here.
It is, always. Making people money.
Securing the bag for everybody who's watching. Stay tuned. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, inflation. We'll be talking about where prices rose and actually where they fell the most last month as well, and the effects that it may have had on your wallet, purse, pocketbook, wherever you carry money or cash. And a new report from Realtor.com says October is this year's best time to buy a house. We'll talk about where mortgage rates are heading. Plus, tax time. Vice President Harris and former President Trump participated in their first and maybe only debate last night. We're going to dig into each candidate's tax policies and what they'll mean to next year's filing. But first, August consumer price index numbers, they are out this morning, coming in mostly in line with expectations. But if you dive deeper into the data, you'll see that inflation is still sticky in some areas, while prices are going down in others. So where should you expect to pay a little bit more or maybe a little less at the checkout these days? Our own Molly Moorhead joins us now to tell us more. Molly, let's start with where prices are rising. Let's get the bad news out of the way first here. What are we seeing?
Hey, Brad. The one that jumped out at me was the cost of eating out. So going to a restaurant is a bigger splurge than it's been in the past. That index rose 4%. Even vending machine prices, we're paying more for candy bars than we were a year ago. That's up. And overall groceries are easing, the cost of eating at home. But certain foods are up. Eggs, which you remember surged a lot in the pandemic, they're up 28% from a year ago. And then another big one that just is not letting up is car insurance. Everybody in every part of the country is feeling this. It was the index was closer to 20% earlier this year, but it's still clocking in at 16.5% right now.
Okay, so not as bad as it was, but still very high right now at 6.5%, as you mentioned there. Where are we also seeing prices fall right now? Some reprieve or some retreat in prices?
So a little bit of good news, although that when something's down, it doesn't mean the price is falling. It just means it's not growing as fast. And where we're seeing that is in used cars. Those were also really high in the pandemic. That price growth is slowing 10% compared to last year, over 10%. And then cell phones, which everybody likes to get a new cell phone when the new one comes out. So that index is down 9.3% from last year. And those are significant. Those are common purchases. We're all kind of shopping for cars and trucks and phones a lot of the time, and that's getting better.
All right, Molly Moorhead with the breakdown there. Thanks so much for looking into the data here and pulling out a few nuggets for us. We appreciate it.
Great to see you, Brad.
Good to see you too. Well, U.S. stocks, they are falling today. The Dow right now is off more than 600 points, and the S&P 500 and the NASDAQ are each off on a percentage basis by more than 1% right now. The sell-off is coming after August's CPI report fueled bets that the Federal Reserve will cut by 25 basis points instead of 50 basis points. Here with more on the market moves, we've got Eric Lynch, Managing Director at Sharf Investments. Eric, thanks for hopping on, taking the time here with us. Help us make sense of this. It seemed like 25 basis points was largely already priced in. So why does it seem that the markets are upset at the possibility that, and the probability certainly shifting towards that reality of a 25 basis point cut?
Yeah, good to be here, Brad. Thank you. So, yeah, I think this is a collective giant recency bias from the last, couple decades of low interest rates. And so, most investors are just so used to rates being lower than where they are today. And given some of the disappointing economic prints from the last couple months, there was a pretty good hope that the Fed could very well cut 50 basis points next week. With the fact that the services index or pricing was up year over year 4.9% in the CPI print, i.e. core CPI is still very sticky. The Fed can't cut with impunity. And so I think investors are disappointed today.
And so with that in mind, where would investors be apt to really place their attention when it comes to the pathway of rate cuts?
Yeah, well, I think that's a good question. Although, whether it's 25 or 50 or what kind of the time frame is over the next several Fed meetings, I think what's becoming more apparent, Brad, is that investors are getting more concerned about the other mandate of the Fed, which is full employment. The fact that it's deteriorating, the fact that while still hanging in there, the economy is still printing, good overall GDP levels in Q2, and Q3 still is forecast to be 2.5. Nevertheless, whether it's jobless claims or it's new jobs or job openings, those numbers are softening. And so if you look at what's happened since the summer really began, low volatility stocks are starting to work versus kind of momentum stocks that had been leading, previously. And that's because, investors are just concerned about what the outcome is for the economy for the first time in a long while.
Yeah, certainly. And so as you're kind of continuing to look through the data points that the Fed is going to be watching, not just going into their September meeting, but even further out, there's been a lot of focus on the employment front as well. How can what we see within employment continue to get the Fed towards their larger dual mandate targets here, and how the markets may appreciate that?
Yeah, well, I think the Fed has already outlined, since Jackson Hole, that they're gotten decidedly less hawkish on CPI or inflation. In today's print, even though core services remains kind of sticky, core CPI remains sticky, and that's a negative for drastic reduction in rates. It is nevertheless because of gasoline, food moderation, things like that. Goods continue to deflate. That is still taking some pressure, and so I think the Fed has some ability to keep reducing rates. What's really going to be interesting, Brad, going forward is what's the economy going to do? Are we really going to have a soft landing? Right now, we are still doing all right. And if the Fed can just mildly reduce rates and the jobs, remain kind of steady, growing, maybe not as robustly, but still growing, then I think, we're all going to start looking more and more closely at earnings growth, which I think we all need to remember that Q2, we had 11% earnings growth, and it was more broad-based outside of tech. So things are not all bad. I think it's time to focus on fundamentals.
And so with that in mind, and you're right on the earnings growth and the broadening that we were starting to see outside of tech. I was noting that actually yesterday with one of our guests per a BlackRock weekly market commentary that they had sent through to our team here. And so all of that considered, where are some of the top buying opportunities that even if we were to see further volatility or further pullback that would initiate some type of larger dip, where are those dip buying opportunities that you're keeping an eye on?
Well, I think this is a period of time, Brad, where the laggards could become leaders. In 2023, things like healthcare and staples and financials did nothing. Tech was up over almost 50%, consumer discretionary communication services all up over 40%. So you've got this huge kind of valuation spread between tech and really everything else. And so what's interesting about Q3 is as volatility has spiked since it started, and IT sector is down 8% quarter to date. Things like the real estate sector are up 15%. Staples are up 9%. Healthcare is up 6%. So it's really, a good time to, again, broaden out your portfolio without a lot of risk. These are defensive categories and sectors. And so even if we have a harder landing or more softening in the economy than we want, a lot of these businesses are still going to probably produce pretty good earnings independent of the economic conditions. And so because the multiples are so low, you're getting a re-rating. So I think that's a really good place for investors to look for their equity exposure.
Eric, thank you so much for joining us here today. Eric Lynch, Scharf Investments Managing Director. Good to see you.
Nice to see you too, Brad.
Well, shelter is still the stickiest component in the consumer price index. It rose 5.2% on a year-over-year basis in August. Meanwhile, if you take a look at data from CoreLogic, price growth has been under 5% for 3 consecutive months, rising just 4.3% year-over-year in its July data. So, what is the outlook for home price affordability? Joining me now, we've got Bob Brooksmith, who is the president and CEO of Mortgage Bankers Association. Great to have you here on the program with us and taking the time. So just help us make sense of what we're seeing in CPI versus what the reading was out from CoreLogic for their July data, and ultimately what this spells out for the future of the, or at least near term perhaps, of the home buying reality for so many prospective buyers.
Thanks for having me on, Brad. And yes, it is true that home prices continue to increase in the low to mid single digits, as the CoreLogic numbers suggest there. And that has been a surprise, given that you would expect, with rates having risen from their lows, now we're seeing nice rebounds to lower levels, but still up a good deal from their lows, and affordability worsening, you might expect that home prices would fall. But what that really indicates is this stubborn supply gap between the housing that Americans need and the housing that's available. So that's why you see housing pricing increasing faster than the CPI. But we are seeing a lot of green shoots with mortgage rates having come down nicely, and we think with more room to come down farther.
You know, it's really interesting. One of the things within the CoreLogic data, at least, they said much of the sluggishness can be attributed to high mortgage interest rates continuing to challenge the housing market and buyers remaining cautious, sales remaining low. However, the highly anticipated cuts from the Federal Reserve this fall may help improve some of the consumer purchase sentiment for the housing market. To what extent are you expecting some of those cuts to actually lead to more purchasing activity, or at least the sentiment to change dramatically here?
Sure. Well, we've already seen in mortgage rates anticipation of the Fed cuts coming in the short-term rates because, of course, they control the short end of the yield curve. But the 10-year Treasury has fallen nicely, and mortgage rates have followed. We just have about a 6.27% interest rate, which is down over 80 basis points from recent figures. And so it is getting more affordable. And we are also seeing encouraging signs on the inventory side, because if there are more people who are willing to put their houses on the market, even though perhaps they have rates that are well below today's rates, you're going to start to see some more movement. And we're seeing our purchase applications increase, albeit slightly, but we are seeing a really big increase in refinances. We're more than double in terms of numbers of refinances today from a year ago. Now, granted, that's from a low base because most people's rates are still low, but people who've gotten loans in the past year and a half or two now should really look at whether it makes sense to refinance and save on that monthly payment, because as I said, the mortgage rates have already incorporated the anticipated or some of the anticipated Fed cuts.
And so, in last night's debate here, Vice President Kamala Harris touted her plan for the housing market. I want to play a clip of what she had to say and then get your reaction on the other side, Bob.
We are going to work with the private sector and home builders to increase 3 million homes, increase by 3 million homes by the end of my first term.
And so how impactful could the plan be for the housing market and affordability more broadly?
Sure. Well, we think this is precisely the area that needs to be focused on, housing supply. Now, to be frank about it, the president doesn't control as much about housing supply and new building as some of the states and localities do, with what can be very onerous permitting and cost of compliance before you even put a shovel in the ground. So we are very encouraged that housing is on the agenda at the federal level. And of course, the president has a great bully pulpit, and there can be carrots and sticks used in terms of federal grants to encourage municipalities to make it easier and more cost effective for builders to build. But we think focusing on the supply side is the absolutely right thing to do. And one of the things that we here at the Mortgage Bankers Association have championed and just got finished through HUD is to make it easier for something called an FHA 203K a loan to get done. These are loans where you can buy a house that needs to be fixed up and finance the cost of making those improvements. And we work directly with HUD and FHA to make improvements to that program. So that's another way we think we can get a productive housing supply back on the market and chip away at this years-long supply imbalance.
Bob Brooksmith, who is the Mortgage Bankers Association President and CEO. Bob, thank you so much for joining us here on Yahoo Finance. Appreciate it.
Thank you, Brad.
Certainly. Turning now to the rental market. Redfin reporting that asking rents rose in August by the most in over a year. We also saw in this morning's inflation data that rents remained sticky. Here with the latest, we've got our own very own Danny Romero in the newsroom. Hey, Danny.
Brad, housing costs remain sticky across the board. In the inflation picture, shelter increased 0.5% in August on a monthly basis. Now, on a yearly basis, shelter came in at 5.2%. Now, this figure is softening if we compare it to when shelter peaked at 8.2% in March of last year. Now, looking at real-time rent data, Redfin reported that the median asking rent price increased 0.9% on a yearly basis in August to over over $1,600. Now, this is the biggest increase in over a year. Now, while rents are ticking up, they mainly and largely are stable due to the influx of apartment supply. Economists at Redfin expect that the asking rent price will continue to stay flat for a while as the backlog of these new apartments make their way to the market, Brad.
Danny, mortgage rates have been declining since May. When is it a good time to buy?
That's a good question. October, according to Realtor.com, found that the best time is between September 29th through October 5th. Now, buyers can save around $14,000 compared to summer sale prices. And there's also a 37% more active listings available than the start of the year. This also means that potentially less competition. So home buying season this year has been pretty slow, but mortgage rates are set to decline further as there's this expectation that the Fed will cut interest rates this month. Now, remember, the Fed doesn't set mortgage rates, but its policy moves influence the direction of where mortgage rates might go. And Mortgage Bankers Association reported that mortgage rates have hit the lowest level since February of last year. So overall, mortgage rates have been on this downward trend since May of this year, Brad.
All right, Yahoo Finance's own Danny Romero. Danny, thanks so much tracking all the data. And I guess October, we'll have to mark off some of those weekends, huh?
Yes.
All right, thanks so much. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Last night, Vice President Harris and former President Trump faced off in their first and possibly last debate. The candidates went head-to-head on the economy, inflation, and immigration. But one topic that didn't get a lot of attention taxes. Both candidates just gave a little teaser of the policies that they're advocating for.
I intend on extending a tax cut for those families of $6,000. My plan is to give a $50,000 tax deduction to startup small businesses.
Everybody knows what I'm going to do. Cut taxes very substantially.
We want to explore both Harris's and Trump's tax proposals and compare them. So here with more, let's bring in a professional, Andrew Gordon. Andrew is a partner at Gordon Law. Andrew, great to have you back on the program. Let's start simply. What do we know about each candidate's tax proposals here?
Yeah, well, thank you very much, Brad, for having me. We don't know very much yet, but there are some basic and very impactful differences. And front and center is the expiration of the Tax Cuts and Jobs Act, which went into effect in 2018. And the Tax Cuts and Jobs Act had several provisions, but across the board, it acted to reduce taxes. And one of the more meaningful aspects of it was also the QBI, or Qualified Business Income Deduction, which applies to many small businesses. There were also decreases to the corporate tax rate and an increase to the standard deduction. While President Trump wants to maintain the Tax Cuts and Jobs Act and also apply new deductions as well, Vice President Harris, from all indications, wants to let this expire. And as of now, in 2025, the Tax Cuts and Jobs Act is set to expire. And so as a result, the taxes that we're used to today, the tax rates that we're used to, could increase unless there are additional deductions. And so that's some of the other areas that Vice President Harris is now proposing.
So would filing taxes get easier or harder under each candidate?
You know, that's the ironic thing. Both of them want to reduce taxes, although they both want to do so in different ways. Yet, as we start to talk about additional credits, deductions, expirations of certain provisions, the tax code is getting more and more complex. In fact, we see all the time that unless you're using professional, in some cases you may not be able to claim these deductions because you just don't know how. And so by increasing all of these things, we're just making it more complex. There were previously efforts to try to reduce or simplify the tax code when President Trump was first elected. But what we've seen over time is really the opposite has occurred. It's just gotten more and more complicated.
What don't we know? Where is the gray area still, or just the black area about each candidate's policy that you as a CPA would like to hear more about?
Well, you know, how would it impact the everyday person? So tax brackets across the board. What we want to know from Vice President Harris is if the Tax Cuts and Jobs Act does expire, if you do allow it to expire, how are we going to fill these gaps? How are we going to allow small businesses to still be competitive? How are we going to allow corporations domestically to compete internationally? And so we know some things, but we don't know these fine details just yet.
Certainly. And then just lastly, while we have you here, the biggest changes that may go into effect and the timing around them, because it's a lot to campaign on and discuss on a debate stage some of the tax changes that could come forward. But what does the real implementation timeline typically look like here?
It often takes years for tax policy to impact the everyday person. But one of the things that we do know is the Tax Cuts and Jobs Act, the TCJA, is set to expire in 2025. So if nothing is done, it will expire. The effect of that will be that there will be an increase in taxes pretty much across the board. So that is certain, and that is happening pretty quickly.
Andrew Gordon, who's a partner at Gordon Law. Thanks so much for taking the time. Great to see you again, Andrew.
Thank you very much.
Absolutely. We've got much more on wealth after the break. You're watching Yahoo Finance. We're less than 2 months away from knowing who will be the next president of the United States, and the stakes are high. Investors are trying to wrap their heads around all of the potential outcomes of November's highly contentious election, worried that it could disrupt their portfolios, but ETFs may offer a strategic solution to navigate some of that uncertainty. For more on how to position yourself ahead of the November 7th election, Jay Jacobs, who is the BlackRock U.S. head of thematic and active equity ETFs, joins us now as part of this week's ETF report brought to you by Invesco QQQ. Jay, great to have you back here in studio with us. Appreciate the time as always.
Glad to be back.
Let's dive into this because you've sent over some really interesting perspectives here. First and foremost, there's a bit more sense that we're kind of getting right now about investors' appetite to be involved in more active ETFs. Why do you think that is right now?
Well, we've had an incredible run for just index strategies over the last 10 years. We've seen the S&P, we've seen the NASDAQ, we've seen really broad benchmark indexes perform very well, delivering all the returns that people could really expect from a broad market index. But now we're seeing more volatility, these bouts of major sell-offs in the market. We're seeing a lot of kind of tactical rotations in the market between growth and value, back to growth, sector rotations. And frankly, we're just seeing more dispersion across stocks and sectors. And all of that really kind of lines up with having a stock picker behind the scenes able to navigate this volatility and dispersion can really help deliver better returns in the future, especially if broad market indexes can't deliver what they did over the last decade.
I mean, we've been looking at some of those broad market indexes here this morning, which have been rattled post-CPI print. And so with two major events set to take place, and one of them going to be more long form, well, both of them pretty long form, but one of them in the Fed's cutting cycle that is expected to commence here in September. But then also you have the November election. Where have you seen some of the ETF strategy start to line up around those two major events?
Well, in two areas. I would say, one, a lot of investors are still just trying to lock in yield right now. An ETF like BINC, which is managed by Rick Rieder at BlackRock, is really trying to capture high yield bonds, emerging market bonds, collateralized loan obligations, and really lock in some of those yields that can be, 5, 6, almost 7%, so people can capture this high rate environment and hold on for a bit. The other area where we're seeing more interest right now is actually a little contrarian to the market. It's looking at value stocks. So this has been a growthy market. In fact, growth is a huge part of the S&P 500 right now. Value is only about 22% of the index, the lowest it's been in 25 years. So contrarian investors are starting to see that actually when there's less value in the market, there's actually more opportunity within value, that portfolio managers and Tony DeSpirito at BlackRock with his BLCV ETF can actually make some really interesting moves that are very different from what you see in the broad market benchmarks.
Interesting. We've talked so much at length about AI and all of the different ETF plays that are out there. And I was trying to figure out what is a more unconventional way that we can really think about access points into artificial intelligence without specifically looking at ETFs that are just based on the names that are directly impacting chips or some of the communications. And utilities came to mind. Is there an AI utilities play that you're seeing start to emerge right now in ETFs?
I love this question because what you're doing is really thinking about kind of the second order impact of AI. You have kind of your immediate winners, but then you have this whole economy that has to be built and support artificial intelligence, including things like energy and electricity production. So absolutely utilities like IDU at iShares are going to benefit from growing electricity demand. In fact, if we go backwards 15 years, electricity demand has not grown in the United States. It's been flat. You've seen more energy efficiency. You've seen a shift away from manufacturing in the U.S., which is very energy heavy. But now you're starting to see that lift up, and utilities are going to make more money as they can sell more electricity. I think one other area to look at that's kind of adjacent to utilities is in the real estate space, which is data centers. These are companies that have pretty steady cash flows. They contract out basically renting their warehouse space for cloud computing and artificial intelligence compute for a long time. And so they both kind of get the stability like a utility of certainty of cash flows, but at the same time, they just get to command a huge premium right now because there's so much AI demand and not enough data center space.
It's interesting. You mentioned manufacturing. That triggered another thought. I mean, based on the ISM data that we had seen, last week, on manufacturing on the, at least product side, that continues to be in contraction here. But if investors are looking for a rebound in that, how can they kind of track manufacturing as a theme via ETFs?
So, manufacturing had been on the decline in the United States, but we're starting to see some forward-looking indicators that this could actually start to reverse. One is manufacturing construction in the U.S. has tripled over the last 4 years for reasons like the Inflation Reduction Act, the Infrastructure Investments and Jobs Act, the Chips and Science Act, which is trying to bring more semiconductor manufacturing in the U.S., has really spurred more construction of factories and retrofitting of factories. So we built a specific ETF called MADE, like Made in America, which captures manufacturers in the U.S. Everything from auto manufacturers to semiconductor manufacturers to, good old-fashioned, durable goods as well. Really trying to benefit from this policy shift in Washington, involving both political parties to support more manufacturing in the U.S.
Jay Jacobs, BlackRock U.S. head of thematic and active equity ETFs, joining us here in studio. Great to see you, Jay.
Good to see you.
Absolutely. Guys, coming up, with a federal rate cut coming as soon as next week, we have some money-saving tips to make sure that you are prepared. We've got that on the other side. Stick around.
For young families for the first year of your child's life to help you in that most critical stage of your child's development.
Vice President Kamala Harris referencing her child tax credit proposal at last night's presidential debate. Financial stress is at the front and center for a lot of young parents in this election season. As consumer goods, those prices for things like food and shelter, those remain top of focus as well and high. So according to a new survey from MassMutual, nearly a quarter of millennials and Gen Z do not plan on having children, with financial constraints being the primary reason. And those feelings, they may be warranted here. According to that same survey, over half of parents have anxiety about not having enough money to provide for their family, with food and clothing being the two largest sources of stress. And it's not for lack of preparation either. Even with 51% of parents feeling worried about their finances, almost 3/4 of respondents said that they have financially prepared for parenthood. According to Paul LaPiana, who is the head of product brand and affiliated distribution with MassMutual, these numbers shouldn't come as too much of a surprise. As he says, quotes, this shift reflects a broader understanding of the importance of financial stability and a dependence in achieving long-term goals that every generation must reckon with, unquote. Well, this morning's CPI prints for August largely coming in line with expectations as the markets continue to expect a rate cut of at least 25 basis points when the Fed meets next week. So, how should you prepare your portfolio in anticipation? Here with some tips, we've got Mark Hamrick, who's the Bankrate Senior Economic Analyst. Mark, great to have you back on the program with us. So, first and foremost, as we're trying to figure out will they, won't they go 50 or 25, even though the probability is largely leaning towards 25 right now in outsized fashion. How should people be, and consumers and households, be putting their own financial preparedness front and center, regardless of the depth of cuts and the pathway of those cuts that we see?
Good to be with you, Brad, and it's an excellent thing to be considering. Because Americans traditionally fail to achieve their savings goals. That's true of retirement savings. A Bankrate survey about a year ago found that most Americans felt they were not on track with respect to their retirement savings. We'll be updating that soon, so stay tuned. And we know from Bankrate surveys over the years that the majority of Americans cannot pay an emergency expense of $1,000 or more from savings. You know, Brad, very often when we're talking about this high interest rate environment that we've been in since the Fed started putting that pedal to the metal a little over 2 years ago, the focus has almost always been on the impact on borrowing costs. And that's understandable because in an affordability challenged environment, you know, the higher cost of credit just is sort of throwing another challenging log on that fire. But the flip side of that, which is very consistent with some of the things that we've been talking about literally for decades of Bankrate, is that this is a tremendous opportunity to prioritize savings. And while maybe some in the stock market might be lamenting the fact that the CPI didn't make a strong argument in behalf of a rate cut of 50 basis points, from a saver's standpoint, I would say that's something actually to celebrate because that means that yields are not going to be coming down immediately with the urgency they would have otherwise. So it really depends on what your investment or savings time horizon is to translate that. It means when do you need the money? And with many Americans sort of cash constrained, the primary opportunity in that regard is to take advantage of high yield savings accounts where you can move the money back and forth essentially from a savings account to your checking account in quick order because we need that liquidity. We need the availability of those funds. And this environment, you're still able to capture a yield, an annual yield of 5% for high yield savings. So that's one of my top picks for those who can lock in their money for a longer period of time, be it 3 months, 6 months, a year, 5 years. That's where CDs come into play.
So with that in mind, I was taking a look at one of the other tips that you had provided us and that we've been able to kind of share with our viewers here. Reducing high interest debt. What are some of the early steps that people and households can take to make sure that they're enacting that part of the strategy?
Of course, in the consumer environment, what's the highest cost interest that people typically pay? Well, that's credit card interest. And for new users or applicants of credit cards with the best credit scores, those who have the best track records for paying their bills on time, those new offers right now, as of today, are still averaging about 20.75%. Now, as the Fed begins lowering interest rates, those averages will come down, but that's going to be falling like a feather, not like a hammer. So absolutely, if you have more than one credit card, take a look at your statement, maybe online, maybe you still get the snail mail version. Know what the highest interest rate that you're being charged involves, and then prioritize that one. I think that's the way to go because that's where you get essentially the best return on your money, paying off that high cost interest right away. Of course, the best way to do this is to use credit cards as a tool where you're really sort of winning on all sides here, and that is if you have a rewards card, a cash back card, you pay that balance off before the interest charges hit within the billing period. And so you're still getting those rewards, but you're not getting hit with the cost, which is the interest charge. So that's number one. For many people, I still think it's probably wise to forestall borrowing, let's say, for a car loan right now. The situation on home purchase is going to be so personal that, there are going to be some people that need to buy a home in the near term. There are going to be others that say, you know what, let's sock some cash away for our emergency savings, because as we all know, anybody who's sort of walked over that threshold, owning a home is an opportunity, not to mention a demand that you continue to pay for things like repair and maintenance. I'd rather see people have more in their emergency savings. So when that HVAC goes out, when the roof needs fixed, when the refrigerator breaks, you have that money in the bank and you don't have to go to those credit cards where all of a sudden you're behind the game once again.
It's an interesting point, and it's a great point in terms of preparing for emergencies and preparing for emergencies even if you're in retirement as well. I mean, we've seen, and unfortunately we're tracking very closely, yet another major storm system that could wreak havoc for homeowners in Hurricane Francine. And so all of these things considered, how have events like that changed how people need to assess their financial preparedness, knowing that those are things that are out of their control, but perhaps some of the financial planning they can bring more into the realm of their control as well ahead of those events?
Well, we know that the higher cost of insurance is a direct reflection of the extreme weather and climate events that we're facing on an increasing basis. And so just in the CPI this morning, checking my notes, motor vehicle insurance is up 16.5% over the past year. And we know there are some states where folks can't even get insurance for their homes. So these are sort of the costs that are very difficult to forecast, let's say, if we're trying to manage our household budget. And, Brad, I think it's really important to think here about the fact that we can talk about, and we should, and we are, the fact that the CPI, the Consumer Price Index, is coming down more in line with historical norms now. That's welcome. That's why the Fed's been in the game of raising interest rates. But there are these significant outliers on costs, which are almost more structural, whether it's housing, whether it's we had the supply chain disruptions that sent automobile prices higher. They've begun to level off, but still we're talking about the average price of a car around $50,000. And most people are not even, you cannot find a new car that's priced at $20,000 or below. And that's sort of the price point where people want to find. So that's all about bulletproofing your household finances to have more savings. Because you know what, Brad? I have yet to meet anybody who said, I saved too much money. Boy, that was a big mistake. Nope, it's always the other way around.
Mark, always a pleasure to grab some time with you. Thanks so much. Mark Hamrick, who is the Bankrate Senior Economic Analyst. Good to see you.
Thank you.
Absolutely. We've got much more wealth on the other side of the break. You're watching Yahoo Finance.
All right, Yahoo Finance is continuing its coverage at the Goldman Sachs Communacopia Tech and Media Conference. And I think we're talking a little tech, but of course, a little stocks right now at Robinhood co-founder and CEO, Vlad Tena. Vlad, always good to see you. Appreciate you.
Always a pleasure, Brian. Thanks for having me.
So let's just stay on the topic of this conference, AI. How is AI going to change the business of investing and change Robinhood?
I think there's two big trends that could change how financial services are delivered. It's crypto and artificial intelligence. And Robinhood intends to be a leader in both. I mean, to a certain extent, we already are a leader in retail crypto. We're doing a lot there. For artificial intelligence, the opportunity is to deliver the same type of advice and tooling and experience that a high net worth individual can get from a very sophisticated private wealth manager or private banker, and deliver that to the mass market. And I think that's the really interesting potential for AI in financial services.
It seems like your platform over the past year and a half has had a rebirth. I mean, you're not an old company, but you're moving very fast and releasing a lot of new products. What are the brokerages, traditional brokerages, not doing? Where are their holes, and where are you taking market share from them?
Yeah, I think that it's really, I mean, you put it well. We have 8 businesses now that are generating over $100 million a year in revenue. So the business has become much more diversified than when we went public. And when we went public, we were really just a transactional business for novice equity and options traders, crypto as well. But now we have our gold product, which gives customers industry-leading yields on their cash, gives them great retirement benefits, an awesome credit card. And yeah, I think Robinhood is looking less like a traditional brokerage. Of course, we have a big brokerage business, but we aim to be leaders in retirement, in wealth management over time. We think that there's a huge opportunity with owning the financials of an entire generation. Robinhood's been very, very popular among millennials. That continues to Gen Z as well. And we think we can be the place where millennials and Gen Zs custody all of their assets, and all of their financial transactions could go through Robinhood.
How far do you want to push your model over the next decade? Are we looking at a point where Robinhood is doing investment banking, for example?
I think that there's 2 ways in which we look at it. One is we have a lot of customers, 24 million customers, predominantly in the US, and we can continue to deepen the relationships with them, starting with all of the financial needs they have on a daily basis. Spending, savings, we've already got retirement, wealth management. A lot of customers don't want to pick their own investments. They want a little bit of guidance. We think we can play a big role there. And then, of course, there's an addressable market of hundreds of millions of people outside of the US that are even more underserved. We've been making a lot of progress with our efforts in the UK and the EU to serve those customers. But then the third thing, to your point about investment banking, is we're building a lot of these capabilities in-house. And if you think about a business or an institutional investor, they also want access to the things we offer. They want 24-hour access to the equity markets, they want industry-leading margin rates, a great customer experience. So over time, I do think you'll see us branching more out into serving other types of customers, not just retail, but also businesses and institutions. And to that end, we announced an acquisition of Bitstamp, a global crypto exchange. One of the things that's very attractive about that business is that it's not just international, but also institutional. It gets us access to an entirely new customer base that we're not directly serving today. I think we can do more and more of that over the next 10 years.
We've seen some challenging times in markets, not super challenging, but it's been a weird end of August and September. I mean, how do you see market volatility playing out as we near an election season? And what do you think the impact is to a lot of the customers on the Robinhood platform who own really these volatile stocks like Nvidia, like a Tesla?
Yeah, I mean, I think there's 2 things. One is we have different types of customers on the platform. So for our active traders who are engaged in more advanced products like options and margin, they have the ability to take advantage of different types of market environment, not just when stocks are going up, but also when markets are moving sideways and going down. So we're seeing those customers engage at a steady rate. For customers that are more buy and hold, they tend to see corrections in the market or volatility as buying opportunities, because the thesis for these customers is that AI and to some extent cryptocurrency is a transformative force, and that's going to play out over the long run. So we announced in August we had around the time of the carry trade unwinding in Japan, stocks got hit very hard, particularly some of the growth names, and our customers by and large saw that as an opportunity to get into some of these names at discounted prices.
Our interest rate, I was talking to Goldman's chief economist, Jan Hatzius, here at the conference. He's looking for really that first Fed rate cut happening at September 18th meeting. Does Robinhood, I think some of the street would think that you would make less money when rates decline. Are they right or wrong?
I think that I mentioned earlier, Robinhood, very diversified business, much more than when we went public, 8 business lines that are generating more than $100 million in annual revenue. And if you remember, when we went public, it was a zero rate environment. We had done quite well in the zero rate environment. Transaction volume and user growth were progressing really nicely, and we were growing at 300-400% year over year at that time. And so the question was, will Robinhood do well in a high rate environment? We had to put in a lot of work to diversify the business and to take advantage of the environment that we were in. But I still think Robinhood is perhaps a stronger company in a low rate environment. Transactions will tend to increase. There's more interest in investing. The margin rates, which we've been doing a lot of investment in our margin product, making sure that's industry leading. And we just rolled out industry leading rates across all tiers. I think that'll do well in a low rate environment. Credit, which is a nascent business for us, but feedback on the credit card from initial users, extremely positive. I think that will do very well in a low rate environment. And so I think on balance, the business will continue to do well, perhaps might be stronger with that macro, and we'll continue to diversify. The goal is really to do well in all market conditions and to really benefit from changing market conditions, not be dependent on low rates or high rates. And I think we've made a lot of progress towards that goal.
Vlad Tenev, always good to see you. Robinhood co-founder and CEO. We'll talk to you soon.
Thanks, Brian.
All right, much more ahead on Yahoo Finance. Do stick around.
All right, thanks to Brian Sozzi for bringing us that interview. That does it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You do not want to miss it.